credit to the firm. So what we are identifying is when the two firms are different, one is more exposed to underreporting and the other less exposed to underreporting, you see they are equal in all other characteristics, how they supply credit to the firm depending on this characteristic. My question is, what happens when I use firm-time fixed effects? How many banks supplying credit to a firm do I need? So suppose that I have a lot of banks in the economy, but on average in Spain, a given firm has a relationship with 3-4 banks, no more than that. Now probably even less, 2-3. You know that in Spain we had a consolidation process, with the saving banks merged, and the number of banks now is very low. No? So the point is, if a bank or if a firm has a relationship with a single bank, we cannot use that firm in the estimation. Because when I use the firm-time fixed effects, I'm killing the firms that are exposed to just one bank. So I need that a firm has a relationship with at least 2 banks in order to be using the relation. Do you agree with that? That's the idea of the fixed effects, no? Okay, so what is the solution then? So suppose that, it happened in 2017 or so, there were some researchers in the Bank of Belgium, and in Belgium apparently 30% of the firms have a relationship with more than one bank, but 60-70% of the firms just work with a single bank. So if I use this regression in order to study the credit supply in the Spanish economy, or let's say in Belgium, not in Spain, I'm ignoring 70% of the firms of the economy. It's a bias because you are only estimating the effect for firms that have a relationship with more than 2 banks. What is the solution? You will discover it. You will see how good you are. What is the assumption? The assumption is that I'm using firm-time fixed effects to control by demand. The assumption is that a given firm demands credit in 2 banks in the same way. I cannot do that, but I need fixed effects. What would you do? It applies to all econometric work that you have to do.
Instrumental variable.
No, instrumental variable is in order to deal with causality, right? So here it's not about causality, it's to control by, I want to see 2 different banks providing credit to, let me call it firm or group of firms, and this is the technique, to see whether the 2 different banks are providing credit to these firms differently.
Maybe multiplying the coefficient for a new variable.
What I can do is something that is called in the literature industry, location, size, time, fixed effects. And this is a paper by Grice and co-authors. I don't remember the year, it's published in Journal of Cost Information. So I remember the first time I saw this paper, it was 2017 or 2016, and what they are doing is, okay, so 70% of the firms just work with one bank. So what we are going to do is we use the industry, so they use the NACA for digit, right? And they use fixed effects for this. They use the location, so they use the province, and they use fixed effects for the province. They use the size of the firm. You know that in the size according to the European Commission, there are 4 sizes: micro, small, medium size, and large corporations. And they use fixed effects for this, and this is the time. And then they use fixed effects for the time. So what they do is to merge all the fixed effects. So they create brackets, right? How do you do that? In a Stata, you have a variable that you have a command that is egen. You know it, right? And then you can say industry, location, size, time equals, and then you use the command group, which means define groups, and then here you define the industry variable, the location variable, the size variable, and the time variable, all together, right? In this, and with this, you will have all the fixed effects that you need. Okay?
There's a command for that type of fixed effect.
There is a command to group fixed effects. So because if in the regression, you remember the magic command that I said, no? Rate, height, dimension, fixed effects, no? You write the explanatory variable, the dependent variable, and then here you have the fixed effects. In this command, absorb. But in the absorb, you need to put all together, multiply. So the absorb allows you to use them individually. So if you use individually, you are not going to do the same. Here you need to write industry, location, size, time, fixed effects. Okay, so what we are doing is, instead of considering individual firms, we are going to say that all the firms that are in this industry, I mean the industry is at the 4-digit level, which is relatively narrow.
A 4D level, sorry, what's that, bro?
Sorry?
What's a 4D level again?
This one? This is the, in Spanish is TENAE. It's a code in accounting to classify sectors. Have you ever seen it? No? So if you go to the, I hope it works, the internet. I don't have the same.
No, it's okay.
I need the connection, because at the bank we need to use a feed test. It's not like to use mine. So the point is, TENAE. If you read TENAE in Google, you will see that you have all the codes of TENAE. And for each sector, you have different digits. You have, for instance, agriculture, let's say fishing, whatever. This 0001. And then you have machinery applied to whatever. Tourism.
Okay, you're controlling by the average of that sector.
No, the average no. You use each sector as a fixed effect.
Yeah.
So remember, when I was explaining this, I was saying, what is a fixed effect? A fixed effect is firm 1. This is the fixed effect, and here you have in the panel data, you have the firm identifier and the year, right? And suppose that you have firm 1 in year 1 and 2. And then you have firm 2 in year 1 and 2. What is the fixed effect for firm 1? It's 1, 1, 0, 0, right? The fixed effect for firm 2 is 0, 0, 1, 1. And then suppose that you have an additional variable that is the sector, the name. And suppose that the sector for this firm is 3, 2, 1, 0. And for this one is 2, 8. I don't know if this sector exists. So what I'm going to do is to create a fixed effect for the sector. So if we, let's say, the sector will be 1, 1, 0, 0. Okay? Then the province. I have another variable for the province. Suppose that this one is, which is the zip code for province starting 40. I don't remember the. Okay, and suppose that this is in Madrid. And then you have the fixed effect for the province, and then you have, let's say here, Navarra. And then this is 1, 1, 0, 0. And then you have another for Madrid, 0, 0, 1, 1. And then what you are going to do is to create multiple fixed effects. So this is the interaction of fixed effects. This is the interaction of fixed effects.
I see interaction.
Exactly. So is that you multiply them together. So you will have a fixed effect here that will be, and suppose that the size is small, so 1, 1, 2, 2, and then I have another fixed effect for the size. Okay. So what I'm going to have is a fixed effect for a firm that is in Mate 3210 in Navarra. Small. Okay, and this is 1, 1, 0, 0. Okay? And if you also consider the time, suppose that this time 1, it will be 1, 0, 0, 0. Okay? So you will have all the combinations for the sector, the province, the size of the firm, and the time. And what you are seeing here is the demand is the same for all the firms that are in the same industry, in the same location, with the same size at the same time. Okay, that's the idea. So if the demand is the same, I'm not comparing two different banks lending to the same firm. Because if 70% of the cases is a firm and a bank, then I need to do the same by comparing two different banks lending to all the firms in the same industry, in the same location, with the same size at the same year. And you are comparing the two banks lending to all the firms here that apparently the assumption is that they have a similar demand. So all of them behave similarly. All are dressed the same, they go to the bank in the same way, they demand, And this is special because of this. I mean, we use this when there are, let's say, more than 25%, for instance, of firms working with a single bank. Okay? This is very useful in econometrics. You can do the same, for instance, let's say that you are working with more macro data. No? You have countries, and at the same time you have different sectors in the country. You have households, you have companies, but you have different types of companies. If you use the fixed effect of the company and the country, and the time, you kill everything. So you need to do an assumption in the sense that, okay, but all the companies in that country behave in the same way. And then I modify the fixed effects to use groups of fixed effects, this common fixed data. And then in the relation that I explained yesterday, you use this. And then you can estimate supply.
Perfect. We always use fixed effects in the data band models.
Yeah.
Always.
I mean,
Almost always.
almost always. I mean, this is what I explained yesterday. If you want to see the cross section, if you want to see a simple correlation, it doesn't matter when it occurs, right? Then you can use the relation with a fixed effect. This is called a pool regression, right? So there you can inspect the data, you can see whether the variables are correlated. But if you want to see, or you want to identify here, in this example, supply, controlling by demand, or what happens with the in a firm, you have to use fixed.
So that's my question. So here for the I balance sheet, I know you're using fixed effects. What are you trying to control for?
What?
Yes, like what are you trying to control for? Like all those four variables, right?
No, I mean, you use, it's not that you are controlling for this. I mean, of course, you are controlling for this variable. It's that you are comparing banks lending to the firms with similar characteristics. I mean, if you run a regression and you don't use the proper controls, of course, I mean, you will have here more controls. What happens in a regression if you relate credit and bank exposure to underreporting and you don't control for any different characteristics? People could tell you the same that you told me yesterday. Yeah, but they could have different leverage. No? And then you can say the effect that you associate to the underreporting can be driven by the fact that the banks that are more exposed to underreporting probably are lending to firms with more leverage. And the effect that you are obtaining is not driven by this, it's driven by the leverage. This was your question yesterday, right? And you were right. So then you will use controls. If I don't use these fixed effects, people could tell me, yeah, but I mean, the point is that probably firms in different areas or different sectors means that the banks are exposed to them differently, and what matters is not what you are identifying, it's just the structure of the bank exposure to these firms. And then you can say, what is the solution? Okay, so let's confirm that we are comparing the credit supply of the banks to firms that are comparable, to firms that are identical in these characteristics. This is what the regression is doing.
Yeah, but those doesn't control for the leverage aspect.
Well, the leverage would be here, right? So I'm controlling for the leverage in the X. So I cannot use infinite fixed effects. I mean, it has a cost, right? If you want to use fixed effects, fine. Then here, besides the industry location size time, you can use leverage thresholds. You can see high leverage, low leverage, and then you add an additional fixed effect. Fine. In some papers, I do this. So in some papers, in which the risk is very important and firms are very heterogeneous, in some papers here I introduce the rating as an additional control. And then I control by industry location size time and risk. And now there are more people doing that.
So how come the leverage is in the X here?
Here in the X, this is a control variable. So you are controlling by the leverage of the firm.
Oh, but in this particular paper, you don't take into account that.
No, I haven't. You see, in this particular paper, I'm using firm year fixed effects. In firm year fixed effects, I'm killing all firm characteristics. And this is related to another question in the last, at the end of the class. Because Danny was asking exactly about this, no? And I was telling him that if you use firm characteristics and you use firm fixed effects, you cannot estimate the firm characteristics. And the example that I was using for Danny is this. Now, suppose that you have one firm 1 in 2 years. 1, 2. And then you have the firm fixed effect, firm year. Firm 1, year 1. Firm 1, year 2. And this is is the fixed effect. The fixed effect would be 1, 0, 0, 1. And then your question is, why are you not using leverage? Because here is the leverage of the firm. This 10% leverage in fact has equity over total assets. And then suppose that this is 10% and 8%. So any firm variable that you want to use here will be given with a linear combination of this. You remember when you have the matrix, no? When you have to do the diagonal that is 1, 1, 0. So when you have two variables, you can mimic whatever you have here. So it's a linear combination, so there is multicollinearity, so it kills the variable. So it doesn't matter if it's leverage, capital, whatever. So, and this is an advantage. So why do we use here firm year fixed effects and bank year fixed effects? Because it allows me, in the case of bank, to control for any type of an observed bank intermediate. And this is why I use the bank time. Okay, that's the reason for using bank time fixed effects. So it doesn't matter the bank variable that you want to consider. You can tell me, yeah, but you don't use the bank profitability. I have bank time fixed effects. So it accounts for any bank characteristic that is missing and that I'm not considering. That's why it controls for an observed bank heterogeneity or an observed bank characteristics. Perfect.
Someone was going to ask us.
Yeah.
Yeah, I was gonna ask. So what was the difference you were using random effects?
Random effects, but that's different, no? I mean, random effects is more when it's not fixed the structure that you have in the panel. But here it's fixed, it's a firm, right? You want to control by the firm and the time.
So what
No,
is exactly?
it's not very common to use random fixed effects in this type of analysis.
So what's exactly getting absorbed?
With the fixed effects,
Dummy variables, or
with the fixed effects you are absorbing dummy variables, exactly.
like the zeros or ones, or like grouping them?
All of them.
Okay.
All of them. So with the dummy variable, you are suppose that you have this. I mean, if you wanna translate that specification into a regression, I told you the example yesterday. No, the person that was using the Banco España computer and he said, look, I cannot work on this because after 12 hours, they tell me that I need to reinitiate the session. No? So what was happening with this person is exactly this person was defining these fixed effects manually. So if you have 1 million firms and 10 years, you need to define firm 1, year 1, up to firm 1, year 10. And then when you arrive to firm 1 million and year 10, probably the session is out and then you need to go back. So what you are using the regression is all these millions of variables like fixed effects. Right? And each single fixed effect here is saying which is the average credit obtained by firm 1 in year 1. This is what the fixed effect is saying. The fixed effect is just an average. It controls by the average credit obtained by firm 1 in year 1. And what is identified in the bank exposure plan reporting? The differences over the average granted to that firm by two different banks. So if the two banks supply credit in the same way, that coefficient will be 0. It doesn't mean that the credit obtained by the firm is 0. It means that if the two banks are lending 5%, the difference is 0. Right? So when is it significant? When there is heterogeneity across banks. Suppose that you have two banks, one offers 10 and the other offers 0. So the average is going to be 5. But the coefficient associated to the differences across banks is going to be 5. You see the point? So fixed effects are not nothing difficult, they are just averages. So suppose that you run a regression, and you run a regression on a variable y. You run this regression in a statement, right? You say reg y x. The coefficient that you get here is what? And this x is a fixed effect. For instance, the fixed effect is being in Navarra. The dummy that tells you whether the firm is in Navarra. And this I is the let's say the return assets of the firm. The dummy, the fixed effect for Navarra is the average return of the firms in Navarra. That is. And what you are doing is, when you were asking me, are you controlling by that? Yeah, I'm controlling by that. I'm taking out the average effect of all the firms within Pamplona. And then if I want to use another variable here, that is, let's say the sector, no? Another dummy. Tell me the sector. This coefficient here tells me. But once I control for the location of the firms within Navarra, I can tell you the effect that is associated to the sector. Because if no, in this coefficient here, you are absorbing this. If you don't use the fixed effect for Navarra, in the sector you will have everything. And then you can tell me the effect of the sector is, no, wait. This is the effect of the sector, but firms are spread over the country. And you need to tell me, you need to control by the location of the firm, and then you can tell me the effect of the sector. If not, you are mixing everything in the single thing.
So for the controls, that will be to handle like the size of the firms?
Well, I mean, size of the firms, whatever controls you want to use. The point is, here I'm using firm time fixed effects, man time fixed effects, and I cannot use controls because all the controls are there. So this is the more saturated specification that you can use here.
So that's like the controls work as a vector, right?
If I mean, everything is a vector, even the fixed effects are a vector.
Okay.
Because you have many variables and you have the coefficient for each variable. So when you have controls, this usually, let's say the beta times x, you see this, I mean, this is a vector of coefficient and this is a matrix, right? Okay? Perfect. So this was very important, I mean, not just for this, which is of course, but also for the research that we conduct. And then, what is the other problem with hard data? We are talking about, I mean, the limitation. No? I was saying that the context matters, no? And I was saying you that suppose that a firm goes to the bank and in the report this year it has a negative profitability. But this negative profitability could be due to many reasons. Probably the manager was sick, the factory had to close because there was a problem, not in this factory, but in a factory close to it. With hard data, you don't know it. You know that you have a negative profitability. With soft information, you know the manager of the firm and you can say, but what was happening here? Well, I was sick, I had a problem, whatever, but this is not something persistent. So this year I'm having a negative profitability, but next year is going to improve. If I don't consider this information, I would say, I don't need you to know. So this is another aspect. And the most important one, at least to me, and I have a nice paper on this, I will show it now, is that if we focus on hard data, what happens with new firms, with the startups, with the firms that are recently created? There is no data. So you come to my office, look, I want to run a business. What is you? No, I have nothing. I will start now. If you don't know the client, if you don't have information on it, it's impossible. And I have a friend, yeah.
Also, for let's say there's a huge firm, in Mexico, and then they open a subsidiary or a new company. It's the same owners, but different name, different thing. You won't have data even though that could be huge in Mexico or whatever it is.
Of course, I mean this also matters, but in that case, I think that you can infer many things about the quality of the managers. The manager has a firm, so I can evaluate the ability of the manager. I can see whether the manager has another firm in the same sector or in Mexico, and then I can infer something from that. It's not perfect, of course, then you need soft information as well. But the very extreme example that I'm saying is that I have nothing. So it's a firm that is created. And I was saying that CaixaBank had like a micro bank that was lending to startups. And you know what he did? The firms went there, and for him it was impossible to lend to firm. And he contacted an American university, and they designed a program, a very nice program. It took like 15 minutes. I did it because it was very nice. And it was just questions, continuous questions, to the person that wanted to run the company. They didn't have anything. And the questions were about their ability or their knowledge about finance, for instance. I mean, what is this? What is that? But there were some questions about the patience of the client, and it was very important. It was, for instance, please don't move the mouse. And he told me that there were many people that, and for them it was like a bad signal, right? Because it means that, and there were many questions that were repeated like 10 minutes later, and they see whether there is coherence in the answers, or 10 minutes later they are answering something different. And based on this, they define a scoring for the companies, because they have no data, so they have to do something.
Is that like a sentiment analysis?
Well, you can call it sentiment, behavioral, or in many cases they are using some soft information, right? I mean, I don't know anything, but you do your smoke and these kind of things. And from that, they had a scoring, and they see that this scoring, this rating was very good in order to predict the behavior of the firm. Of course, I mean, they ask about the income of the guy, the wealth, whatever, I mean, or they have collateral costs. But for this information, they are using that. But for the firms that are newly created, there is not that information. And for the firms that are created but don't have bank debt, I can see the financial statements. But if I'm a bank and I go to Banco España and I say, look, how is this firm paying the loans to the banks? I have no information. I have no scoring, I have no data. Right? Do you think that is a problem? How many firms in Spain do you think that have zero bank debt? Spain is a bank-based economy, so everything says this. How many firms?
We have small firms that
Which is the proportion? Give me a number.
20%.
20%. More.
More than that, don't have any driver.
Like 50%.
Really?
I mean, the point is that we discovered this during COVID. So what happened during COVID? You remember, no? During COVID, you remember the ECO program. Don't say this to anybody. It's a secret. I was the one that gave the number to the government to design the program. Okay. So I need to classify firms and to see the financing needs of the firms, right? So the first thing I did is to go to the credit registry and let's see. Suppose that the economy stops for 1 year. How much money do they need? And then I have to consider the debts they have to repay, the problems they have, the clients they have, the liquidity they have, and then we needed to do an estimation. I mean, two people and me, the three of us. We needed to do an estimation to see the size of the program. What we discovered is that there were many firms that needed money, but they didn't have bank debt. And this is an issue, because in the context of the COVID, what happened with banks? The client comes to me, I have a credit with this client, another person comes to me, I don't know you, sorry. So when the client comes to me, says, look, I need money. The other person says, I need money. Who is your bank? I have no bank. I'm not going to give you money. I give money to my clients because they can continue repaying the debts they have with me. And many clients substituted the standard loans with the eco loans that were cheaper. You know the eco loans, no? What I'm referring. During COVID, there was a problem for firms. They didn't have access to finance. What the government did is to design a program in which the ICO, you know, the ICO is Instituto de Crédito Oficial. This is a public bank. Now the president is someone that was teaching here also at the University of Navarra 10 years ago. So the Instituto de Crédito Oficial is a public bank. So what this public bank did during the COVID is, I'm going to offer public guarantees to firms, which means that a firm goes to the bank to ask for financing, and if I use this program, it means that if the firm doesn't pay, 80% of the losses are going to be covered, up to 80% of the losses are going to be covered by the government. And the rest of the loan, 20%, is going to be covered by the bank. Right? That's the idea. So it's not that the public bank was giving money directly to the firms. The bank were giving money to the firms, but there was a guarantee, we will see later, that was a public guarantee supporting the losses of the firm in case they cannot pay. Okay? That's the idea. And then we have to decide which is the size of the guarantees, of the collateral, that this institution can provide to the firms to sustain the economy for 1 year and avoiding having problems of solvency. But in the end, the banks that were lending were the ones that were deciding to who they were lending, not the public bank. Okay? And what happened, as you can imagine, is that banks did what? They were using these guarantees to lend to riskier clients In case they don't pay, 80% goes to the public sector, to the government, and I just pay 20%. And they were doing that with the clients with a longer relationship.
So they help the people who didn't have any relationship at all.
And this is where this paper comes from. So I had some issues with this paper because politically it's so in the sense that finally you are helping your clients, but the one with the bank debt will be that's the part of the story. I'm doing a spoiler. But there was something worse. I published another paper on this and it appears in the news. I had a lot of nightmare. I was not admitting into this because the newspapers collected my papers in the wrong way. So what I was saying in that paper is not only that they were lending to the clients, it's also that they were charging higher interest rates to clients that cannot go anywhere. Right? So you are a firm, you are risky. So you are my bank, please give me a loan. And they say, okay, sit down, let's see. So instead of saying, I'm going to give you a loan, and you pay 3%, I'm going to say I give you the loan, but you have to pay 3.5%. Right? Because they were captive, so they cannot go to other bank. Okay, so it worked, the idea was good, the issue is that, but this is on the record, to see the program. So what happened here? So what happened here is that this is the proportion of firms that don't have bank debt in the Spanish economy, but it's not just a case of Spain. You see, in Spain it's at a bit more than 50%. It's like a 53%. In Belgium, 50% of the firms don't have bank credit. In France, it's 20, but it's not that 20% of the firms don't have bank credit. It's that in this sample, the French firms that report data are very large, so there is a bias. So don't take it seriously. If you see, that's why I'm reporting here the diamonds. You see diamonds? The diamonds are the median of total assets of the firms in the sample. And you see in Belgium, they are very small, 200,000 euros is the right scale. In Italy is the same, in Portugal they are very small, in Slovakia they are very small, but if you see France, it's 7 times larger. It means that the French firms that were reporting data here are 7 times larger than in Spain. Okay, so don't take the part of France seriously, it's much more than that. But you can see, for instance, in Italy, 65% of the firms don't have bank debt.
When you say they don't have bank debt, is that they don't have the ability to finance themselves with banks?
It means that in their balance sheets, the amount of bank debt is zero. During the last 5 years.
Okay, during the last 5 years.
Yeah, I mean, it means that the persistency is very large. It's not.
No, I was going to ask
Yeah.
how much is the percentage relative, like in the US, for example?
I cannot tell you the US. I know that it's also large, probably not so large as here, because I mean they have alternative sources of financing, but I don't have an idea for this. But also large. It's not that it's something negligible. So this problem affects everybody. But the point is that we are talking about banking system, blah blah blah. 50% of the firms don't have a credit. It doesn't mean that they don't have bank accounts, deposits, whatever. No, I mean you have some connections with banks. I'm not saying that the connection is zero, but this is an issue.
So if they don't have debt, it's because they haven't asked for a loan, no? Because
this is a good question. I'm going to give me 2 slides. This is a very good question. Why do they have bank debt? No, this is the question.
So I'm assuming were they all listed firms?
I mean, in Spain we have 125 firms that are listed. In Spain we have 2 markets, no? I mean, we have the IBEX, which is the one that has 35 firms, but bigger than that we have something that is called Mercado Continuo. The Mercado Continuo, I don't know the number of firms there now, but it should be like 130 firms or even less. And then we have something that is the map. I think now the map is different, it's something like growth market, or I don't remember the name, no? You know what a mercado alternativo is? An alternative market is, you know it? So these are stock markets that are designed for small firms. In the sense that this is an advantage because in the Mercado Continuo you have to report a lot of information every year. So you see the accounts of these firms and it's 300 pages, 200 pages. In this alternative market, the information that firms have to report is much less. Much less. So it's for small firms that don't have the ability to work in that way. Right? And then the bureaucracy is lower, and this is done for small firms. So when the small firm appears here and they grow a lot, they go to the Mercado Continuo. So this is an alternative market to help firms to finance in financial markets. But here, I don't know how many firms, probably 30 firms or 20 or whatever. So in Spain, we don't have more than 200 firms that are listed.
Is there a liquidity enough in the second market?
No. I mean, if you see the trading in the primary market, in the secondary market here, in the Mercado Continuo here, it's not comparable. So the liquidity is much less. Because, I mean, you know the floating, the free floating, no? You know what is that? So it's the proportion of the stocks of a company that can be traded. Here, they are large and the free floating is very large. So there are a lot of proportion of the firms that can, of the shares of the firms that can be traded. These are small firms that belong to families, and the proportion of shares that can be traded is much less. So it affects liquidity, and also they are risky, right? So I mean, it's not that the clients that are here do high frequency trading. With these firms, I can do trading here and I can do trading in US, no? You know the American Depository Receipts, no? You know what is that? So Telefonica, for instance, Telefonica is listed here, but it's also listed in the US. And the American Depository Receipt are the prices of the stocks in Telefonica in the US. Right? So these are receipts of the shares of the company, but they are listed abroad. Okay, and there is some different requirements in terms of depositing or being listed. In Spain, you know that we had 4 stock exchanges up to recently, one in Bilbao, other in Valencia, Madrid, and Barcelona. Now we have a single one. And the issue is that in the past, you see the prices in Madrid, Barcelona, Valencia, and in some cases there were differences. So the arbitrage, in some sense, whereby anyone, I mean, a few cents is not that was huge, no? But with high frequency trading, you know what is it, no? High frequency trading. Now the trading, more than 50% of the trading of the shares is done through algorithms. So you go to Madrid to the stock exchange now, it's empty, there is nobody there, right? In the stock exchange, where the traders usually negotiate. Everything is in Las Rozas, they have all the computers there, and they send the orders through the algorithms to there. So it's every second they send a lot of orders. So it's not that they negotiate like in the past. So in the past, when there were 4 markets and the negotiation was by phone, for instance, there were some managers that could exploit the differences by phone in one stock market and the other. That's why the prices converge, but there could be some temporary differences, depending on that. So the point is that, yeah, I mean, this is not something that helps a lot for firms to finance. But you are going to the main problem. So the problem is that in Spain, the firms depend a lot of bank debt, and we don't have a diversification of financing sources. And this is something that is under research now. We are working a lot into that, and we are given some advice and some solutions. For instance, you know, venture capital. No? I mean, we are working a lot on this, on venture capital, to see what happens. And you see that the firms that obtain venture capital, they are very research oriented, they are very innovative, and they grow very fast when obtain this. And in many cases, the banks don't lend to these firms, but when I have a venture capital firm that is behind, the bank, I mean, they are not able to discover what happens with the firm, but when they discover that there is a venture capital behind, the banks in some cases lend more to this firm, no? Because they see that they have potential to do. So that's the issue. I mean, they are small firms, related to your question, and they represent around 30% of the 35% of the gross value added of the Spanish economy. 50% of the firms, 35% of the gross value added. They are small, but still is 1/3 of the Spanish economy is with these firms. Okay. So the problem is your question. What explains this? So there are some theories that are related to supply side. So these banks don't have bank debt because banks are not willing to lend them. So this is a story of supply. So I don't know you, the information that I have on you is incomplete, you are very risky, I'm not going to lend you. So one part of this are the banks. And this is important because when you see the characteristics of the firms that don't have bank debt, they are young, they are small, I have some characteristics there, no? That they are have more financial infrastructure. So all the characteristics are related to firms that could be risky or firms to which banks are not willing to lend because I don't have good data to have data. For this, you need soft information. But there is another theory, I'm going to your point, that is demand side. So they don't have bank debt because they don't want. Why? Because in some cases, you have this hypothesis of financial flexibility. You know what it means? The financial flexibility hypothesis. Firms don't want to be over-leveraged in order to have the flexibility to invest when they have a good investment opportunity. So if I just take debt and I'm not investing, so when I have a good investment opportunity, I go to the bank. They say, well, you're coming yesterday, and they say, look, I mean, I have 70% of your assets are leveraged, so I cannot leave you alone. Right? So that's why they prefer not to do so. So that's why it's not very common, unless the firms have a good investment opportunity, to ask for loans to many banks. It's useless to ask for credit if you don't have good investment opportunities. And that's why many firms say, look, I don't want to have bank debt because I don't know where can I invest. Suppose that small companies and small businesses. Okay. The other is the managerial entrenchment hypothesis. I mean, some managers don't want to have banks because probably banks can affect the decision of the firms. And so, look, I don't want banks here, so it's my company. This is very Spanish solution. No? I take my solution. I don't want the banks because I don't need them. And the other is that many of these firms are family-controlled firms, and the point is that the parents, no, they want to deliver the company to their children in perfect situation, and they say, look, I don't want to have bank. And it makes sense. The problem is what happens for firms that don't have bank debt when they have liquidity needs, when they have a shock like COVID. And this is a good example to study what happens with these firms, because everybody needed money there, not to invest but to survive. Okay, I need to pay my employees. Of course, there were many public programs, the government did many things, but in the end, I need to. I mean, I talk to many people going to the bank with companies these days, and they were not asking money to invest; they were asking money to eat. They were telling me to this, look, I have to feed my children, so I don't have any income coming these days, so they were asking for financing to the bank. And that's a problem. I mean, there are a lot of informational asymmetries. This is what we were learning about hard information and what we were studying today, because I don't know anything about the fund. So we are going to see what happens when the bank knows anything about the firm and you have a shock in which everybody needs money. Okay, so this is the causal effect that we are using here. Sometimes we were talking about the instrument, about the causality here, and what causality comes from a shock. And the shock is the COVID because it was unexpected. So nobody was expecting COVID, right? So if firms knew that COVID could occur, they could have asked for financing. It's true that since February, I don't remember if you were in Spain at that moment, probably you were very young, but I had some friends in Italy, doctors, and they were traveling to China to take Italian people that were living there. No? It was February, and they were describing me the situation. I didn't took the bus when I discovered this, and I mean, it's something that was since February. It was expected. Here in Spain, people call me, you are crazy. That's amazing. So, if firms, in some sense, in this period, have asked for bank credit, we didn't check this. No? This is something interesting, for instance, to check. I mean, what happens with the firm that at the beginning, in February, they ask for a loan or they ask for a relationship with a bank, discounting that probably they will need more money if this is a disaster. No? This is something nice, for instance, to check, talking about it. So the problem is that the firms that didn't have bank debt, and I'm spoiled, they face a lot of problems to obtain financing. Banks were not willing to do it.
So, is there any research regarding, I don't know how it worked since I was working in the States when COVID happened. So, tax incentives were really exploited by corporations in the States to the point where there was a whole drama about how small businesses are still going bankrupt and big companies were basically framing their structure to be able to apply to this tax incentives, and they did a whole study on that in the States. That they have similar stuff here in Spain. They have a different far away to prove for how COVID impacted, even though they have incentives. I don't know how it's being.
There are some papers on that, more using American data, not enough papers using Spanish or European data. The problem is that the tax treatment of equity and the tax treatment of debt is not the same. So the tax treatment of equity of debt is more beneficial, right, in Europe. There has been some regulatory changes, for instance, in Belgium, and I know that there are a couple of papers studying this using data from Belgium, because this is a very important topic, right? In the sense that, I know that in Europe there are some initiatives or laws trying to deal with this in the sense that they want to push, in some sense, the financing through equity and minimizing or reducing, in some sense, the tax benefits that the firms can obtain through debt. Right? But I mean, probably in the past this was an issue. You see now what's happening in Europe and especially in Spain. There is a deleveraging process of the Spanish companies which started in the global financial crisis and they have deleveraged a lot. So I mean now the proportional debt of firms in Spain as compared to the global financial crisis is less than half. Right? Which means that I mean it's not that the point is that they need to finance. Doesn't matter if it's equity, doesn't matter if it's through bonds or banks, but they need to invest. That's the point. The point is that if here we consider that the debt is bad, bank debt is bad, fixed income or whatever, and I don't obtain financing, I cannot invest. And I don't know why, but there is, you see this is an issue. We are studying this, and the Spanish firms are deliberating. So it's not that because I have tax incentives in there, there is a debt overhang problem. No, it's not the case. It's just the opposite. The firms usually use 3 years, just 3 years, from the peak to the valley of the level. Just 3 years. So in 3 years they deleverage. And in many cases, the debt they reach is close to zero. The medium term. Right? So the problem is not let's move that because there is a lot of debt. No, the problem is that there is no debt. And you will see it over time. So the problem is that these firms didn't obtain credit during the COVID. You can tell me, probably they are risky. Fine. The ones that are risky did not obtain credit, but the ones that were safe were not able to obtain credit because banks were lending to the clients and banks didn't know that. And this was a problem because many firms with zero bank debt were liquidated. We said this in advance, and this was an issue. And with this paper, we confirmed, my co-authors and I, that we were right. This was an issue. Many of the firms were liquidated. And we published this paper like in 6 or 7 months. We went through a journal and the SFTD immediately because it was really new. Right? Nobody was aware about the proportion of firms without bank debt. And something that mitigated the problem, and that's why I was talking about the ICOs. I'm not crazy. When I say something funny, it's talking about ICO. I'm talking about ICO because something that mitigated the problem were the guarantees. And we are going to see it later in the slides. This is the role of collateral. So I don't know you, but if there is collateral between you and me, not your collateral, your collateral in a crisis like COVID probably is useless. Look, I use my money or my salary, I don't know what is going to happen with you. But if you have a public guarantee and the government is behind, probably I'm more willing to lend to you, right? Even when I don't know you. So there are two things that mitigate the problems of asymmetric information. One is the collateral, in this case the public collateral, not my collateral. And the second is that firms have good financial reporting. That the firms, compared to what I explained yesterday, that the information that the firms were reporting in the balance sheets was appropriate. And here banks were checking it very clearly.
So the banks lended to their clients, but because they knew them or because they knew they were riskier. So what do you explain the two together?
They were. I mean, I don't have the paper here. I can, but let me explain it. So I have a paper in which I compare a firm going to a bank, and I see the proportion of loans that they have with public guarantee and the proportion of loans that they have without public guarantee. When the firms were risky, the proportion of loans with public guarantees was much larger than the loans without public guarantees. When the firms were very safe, banks were not spending these guarantees with these clients. When the firms were very safe, they were lending the banks themselves. Okay? So they was, look, I give you my money and let me use the collateral for you. So this is one thing. When they have to choose. On the, you know the difference between the intensive and the extensive margin. No? The intensive margin is when you refer to the size of something, and the extensive margin is when it's yes or no. Right? So I was talking about the extensive margin. So I'm lending to you depending on, the point is, when I have to lend to the firms, conditional on being risky, I only lend to my clients. So I'm not going to lend to new firms that I don't know and they are risky because I have a lot of risky firms to which I'm exposed, and I want them to continue paying to me monthly the rent.
I'm sorry, can you repeat again the difference between extensive and intensive markets?
So in lending, in banking, you have the intensive margin for credit, no? And the extensive margin. So the extensive margin, when you lend to a firm, is you give a credit or you give no credit. Okay, this is the extensive, yes or no? The intensive margin is, let's say, conditional on lending you lend much or you lend less. Okay, so this is the intensity of lending and this is the decision. If they lend or not, right? So what your point is, first of all, this is something, the extensive margin. The decision is, once you are my firm, you are risky, you are safe, I'm going to give you the credit. The point is I lend money with guarantees or without guarantees, right? Within the clients, risky, safe. The extensive margin is, I need to decide whether I lend you or not. And here, I don't consider the risk. I consider whether you are my client or whether you are not my client. So the problems with the, I'm referring to zero bank debt firms as said BD. So the problems with the zero bank debt firms is this, the extensive. In many cases, they were not lending to them. Okay? And these are the consequences that I was saying. So the consequence for this is that many of the firms had to exit the market. They couldn't survive. The point is it good? Well, I mean, at the end, this is a decision taken by the bank. On the positive side, you can tell me that if they are risky and they don't have bank debt, it means that there are no new firms in the system that are very risky and are bad for financial stability. On the other hand, if they are safe and they really need the money, it's a bad story, right? Because they are not able to survive because of this. So the paper, again, for you, this is the data set, and the data set, you see here, this is the same idea as yesterday. No? The first one is the balance sheet of the firms, and then here we have information on the firm characteristics, you have the fiscal identifier for the fixed effects, no? The sector, location, blah, 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 and you will see now how important are the fixed effects that I explained before. We have the credit register, where we have information at the loan level, and we have, again, granular information on the loan, because we know whether the amount that is newly granted, the amount outstanding, whether the loan has collateral, whether the loan doesn't have a collateral. So we have all information about the loan. If the collateral is public, if the collateral is private, if it's real collateral. So in some cases you see, for instance, for real collateral, people use SIPs in order to collateralize a loan. I mean, I'm not joking. I mean, some loans granted in the coast, you see that rich people use a SIP or a boat in order to collateralize the loan. And then we have the information request, and this is what they said yesterday, no? You remember what are the information requests, no? The information request is when the bank calls Banco España and they say, look, I want to see the amount of credit that this firm had and whether the credit is performing or not, okay? And we are going to use this as a proxy for loan applications. Again, it's not that I don't know all the firms that are applying to a bank. I only know a few cases in which the bank asks for information to Banco España. In many cases, the loan is granted and they don't go to Banco España to ask. Remember the paper of the support.
So one thing I'm not understanding, is it more healthy for a firm then to have debt with a bank because they have access to more loans? Is that the interpretation of this?
Under a shock, when asymmetric information is very important, a shock like COVID, if there matters, what I'm saying is that the firms that had a credit relationship, that is the firms for which the bank has hard data, and also shock information, these firms could survive better than the firms that didn't have a relationship with the bank. So I'm not saying that firms need to have a lot of leverage. No, I'm not saying that. I'm saying that having a bank relationship is positive when there is a shock like this, because banks know you.
But you said they have relationships in other senses beyond loans.
Yeah, and that matters. I mean, for instance, the firms have deposits, and the banks can see in these deposits the payments that they are doing. This is information that they can use. We have now a new data set, you know, the Fondo Garantía de Depósitos, the deposit guarantee fund. So in Spain, up to 100,000 euros are guaranteed by this fund, of the deposits of households.
So that basically just, I think the summary is basically, it gives you more alternative during hard times. It's like having a Walls in France that you have on the ground.
Exactly.
If something happens, you can always have, if you have a relationship with that wealthy friend, you can ask for money
Exactly.
that you don't have it at all, right?
Exactly. So this is again about what I said. This is hard information. So what I'm saying is that in a shop like this, both information matters. But there are some firms who there is no hard information approach. I'm not saying that the information is here, and this is a very important point. Suppose that a firm has a deposit in a bank, and the bank can see every month the payment that the firm is doing with the deposit, right? And I know that the firm has a lot of liquidity with me, and then I can decide to give you a loan based on that. If that's the only channel, of course, I mean, it goes against me, no? If that's the only channel, because of firms or most of the firms have deposits, the result wouldn't be significant. What I'm saying is that it's not the amount of leverage that you have, it's to have financial sources that are well diversified. Bank is an example, but suppose that you have bank debt, and then you receive a shock like in the global financial crisis that affects the bank solvency, and banks are not willing to lend you. And you have bank debt, but you cannot bring money from here. On the contrary, the firms that are in the market that I said before, the alternative market, they can obtain financing through other sources, not necessarily through banks. What I'm saying is that having a well-diversified structured financing sources is important. So the extreme case is firms that have equity. The second case is firms that have equity and bank debt. Fine. Firms that have bank debt and bonds, whatever. So the more diversified it is, the more easier it is if a shock comes from banks to go to other funding sources. Okay? And there are some new papers analyzing exactly this. No? Okay, so the variables of interest here. So I have prepared the slides starting with the basic, that is the data. Then what is what we want to measure here? How do we define the variables? The main one is the variable considering whether the firm has new credit or not. That is, we are focusing on what? On what I said before, no? The extensive bank. So I don't want to see the amount of credit they obtain. I just want to see whether they are able to obtain a loan. Okay, so the variable of interest here, the dependent variable is a dummy that is 0 if they can obtain a credit, 1 if they obtain a credit. I told you that we are going to compare pre-COVID and post-COVID. You know what difference is? Have you studied this? Different this, no? Okay. This is differences in difference durations. So a difference in difference duration is like in the hospital, no? I mean, when you go to the hospital, someone receives a treatment, what they do, they have two groups, no? They have the treatment group and the control group. The control group is like a placebo. So they have a pill. They offer the pill, the real one, to the treatment group, and to the placebo group, they offer a placebo group. Up to the treatment, the two groups are the same. They need to obtain people, and you will see that I'm explaining this because here is the same. They need to obtain people that are comparable. I mean, I cannot compare the effectiveness of the pill if someone is 90 years old versus a person that is 20 years old, no? Or if someone smokes versus someone that does not smoke. Or if someone practices a lot of sports versus someone that doesn't. So the point is that you need to use individuals that are identical. Right? So up to that moment, they have an illness and they are identical. And then the treatment comes. So the ones that receive the effective pill are treated. The ones that receive the placebo, they continue the same. So what the difference in difference does is what? They compare the differences. Because they compare the differences between the two groups before and after the treatment. Right? That's the idea. So before the treatment they are identical, that's very important. After the treatment they are. And then I can measure the effectiveness of the treatment after if they are identical. That's why in the difference in difference analysis there is something very common that is called the parallel trends. Have you heard of it? Parallel, I don't remember the years. The parallel trends. So you have these slides, and the point with these guys that receive the treatment is before the treatment, I know that, for instance, suppose that these are the parallel trends. The most effective way is that in terms of, I don't know, here you can use any type of, this is, suppose that this is the, I don't know, a Y variable that tells you how they feel in terms of whatever. Scoring for the illness, right? Let's say. And you have the two groups, this is the treatment. The T is the treatment. The two groups are the same, so they behave similar in terms of this scoring. After the treatment, you see that the ones that are not treated continue here, and the ones that are treated flat go to zero. And what we are measuring is the difference between the two groups here. It has to be zero, and the difference between the two groups here is significant. Why do we say parallel trends? Because in some cases it's not perfect to obtain two groups that are identical. So it's very difficult to me to say that the firms with zero band depth before the COVID were identical to the others. And that's why in econometrics we call it parallel trends, because they say, look, fine, this is the credit that they obtain, let's say, and I know that the zero band depth firms obtain much less credit before COVID. Fine, and the other ones that have depth, this is the zero band. And the others that are not zero band depth obtain more credit, but what is important is that the difference between these two lines is parallel. That's why they say parallel trends. So if they increase, suppose that, okay, so here up to here, I don't know what happened in the economy, but they were obtaining more credit, and these ones were obtaining more credit. The point is fine, but they are parallel. Right? That's the parallel trend. So what happens here? So after the COVID, the ones that have zero band depth probably continue here or drop, and the other one increase. And what we are measuring is here the difference is constant, but here after the COVID is one obtaining much more. So in order to run the difference in difference specifications, you need to see what happens before and what happens after.
That's called different analysis.
Yeah, that's the idea. And I will tell you now how is the regression. So, given that I have a difference in difference analysis, I need to use information before COVID and after COVID to see the credit that firms obtain before and after. Look the period. Before the COVID, I use a variable that is equal to 1 if the firm obtains any credit between March 2019 and December 2019. And during COVID, between March 2020 and December 2020. Do you know why I use this? You can tell me, why are not you considering January or February 2020? There was no COVID there. When you use this type of variables as credit or other variables that have seasonality, you know what seasonality is, no? You need to compare months that are comparable. Okay? So it happens, for instance, this is done to avoid seasonality. So, credit cards. When you see, okay, what happens with credit cards or consumer credit? And if I don't consider seasonality, and I compare, let's say, December, Christmas, people use much more consumer credit, versus January, I'm going to see differences, of course, but this is by default because of seasonality. Or if you compare summer, when people use more consumer credit to go holidays, it's very frequent nowadays, and you compare it with January, which people don't, they don't have more credit to use, you are going to see differences. So what I'm doing here is, I'm comparing the same months in 2019 with the same months in 2020. Okay, because otherwise I cannot do this. Fine. And another dependent variable important is the exit. You know, in the data set, in Savi, for instance, the data set that I was mentioning, this is another variable that you can consider going back to this. In Savi, I don't know if you have Savi, but you can ask. In Savi, there is a variable that tells you whether the firm has exited the market. So if the firm has stopped the activity, right? And this is what we use here. So this variable is 1. If the firm has been, in Spain, you know that being liquidated, going back to your point, Alex, no? In Spain, it's not like in the US. The bankruptcy law in Spain takes a lot of time, and the provincial, let's say, organisms that are in charge of that have a lot of work, and it could take years. So from the time in which the firm asks to be liquidated to the point in which the firm is liquidated, when the firm is liquidated, the financial statements are totally destroyed. It's not like in the US. That's why in Spain we have introduced something recently that is called the fresh start. Okay? The fresh start wants to favor firms to liquidate in an early stage so that they have a second opportunity to survive. Okay? But this is the exit before being liquidated. Right? This is important. For those of you that don't know corporate, it's not that the firm has been liquidated, it's just that the firm has stopped the activity. Fine. Which is the main explanatory variable? A dummy variable that tells me whether the firm has bank debt or not.
So here's a question on the first part. That's like chapter 9. That's the
Yeah. But in Spain, the point is that it takes a lot of time. There are a few hundreds of firms that are liquidating. It's not that there are like in the US. And when they are liquidated, it's because they are totally desperate and they cannot do anything. And from that time, in which they require to do so, up to the end of the process, so there is not a second opportunity. That's why the fresh start mechanism was used. So the point is, zero bank debt firms. So when you try to define something, the point is, here is zero bank debt, but it applies to anything. Don't check the last information you have in the data. So if you check the last information you have in the data, you could have a problem because there is a lot of seasonality in everything. So what we do here is, okay, so probably they don't have bank debt now, but going back to your name, Robert. I don't have bank debt now, but probably, related to that, no, I don't see whether they have deposits or not, but I can see whether they have bank debt in the last 5 years. So probably they don't have it now, but I had it like 3 years ago, 2 years ago, and the bank knows me, right? So what we require is that they don't have any type of bank debt in the last 5 years. This is to ensure, okay? So my advice here is when you go to data, don't use the first thing that you receive. Try to think about it, right? As you are doing now. Okay. So characteristics of the firms. What time is it? I don't know. You don't get break.
Break.
The last slide. Okay. So here, you see the difference between the firms, and I am approaching to that figure there. You see the difference here between the firms that have no bank debt and the firms that have bank debt. What I'm doing here is, I'm using all the tables to give you ideas about how to proceed. The first thing when you write a paper is to show the descriptive statistics. So when you see a paper in which people don't show you the descriptive statistics, or at least a figure, right? Everything that can be summarized in a figure, in a table, descriptive, this convinces me. Otherwise, with regressions, I can give you the result that you want. I can play with the data, I can play with the fixed effects, I can play with the standard errors. I can give you the result that you want, believe me. So I want this to be significant. Give me 2 days, and it will be significant. But if I don't convince you with this, there is nothing to do. The first figure is proportion of firms that don't have bank debt. Okay, so this pays attention to, attracts the attention of the audience, no? The second thing, show me that they are different. Okay, so here you see, for instance, in terms of the size, the age, the liquidity ratio, and it answers many of the questions that you had before. Zero bank debt firms with bank debt. They are very different in terms of size. Of course, they have to be smaller. Also, in terms of the liquidity, look at the liquidity ratio. It's 33% over total assets, of liquid assets, firms that don't have bank debt. And the firms with bank debt, they need much less liquidity because they have debt and they can ask to the banks for credit lines. But you see the difference. If I don't have bank debt, I need to have liquidity enough in case I need the money. Which again, this is very Spanish oriented attitude. No? I have the liquidity, I don't need to ask them. The working capital, you know what the working capital ratio is? Is the current assets minus current liabilities relative to total assets, no? Which is a measure of liquidity, no? Let's say. And you see also the difference there is double. And the tangible assets, you know why the tangible assets are important for firms?
Tangible assets liquid.
to use them as collateral, no? I mean, you go to a bank, you ask for a loan, the bank will tell you, okay, so which is the collateral you have? I don't have tangible assets. Sorry. I mean, and you see the difference, no? The firms with no bank credit has tangible assets ratio that is almost half the one of firms with bank debt, because firms can go to banks and ask for money and use collateral. Okay? This is the first thing. So the second thing, and your question before, you are comparing firms, and I was referring this because I want to go to that figure, right? To have the firms that are very similar in the ex-ante figure. And then you can tell me, yeah, but you are comparing firms that don't have bank debt, but they don't apply for credit. So if they don't apply for credit, I cannot do anything. So probably the effect that I'm identifying, the negative effect on the access to credit of firms with no bank debt, is because they don't apply. But remember the data that we have at the Banco, which is a dummy that tells me whether the firm has applied. Not directly this, whether the bank has called the Banco de España to ask for information of the firm. And this is equivalent to say that the firm has applied for a loan. So we restrict the sample. You see the number of observations that we have here, and this is related to your point. We restrict the sample. Here we have 120,000 observations, and before imposing this, we have more than 500,000, because we are restricting the sample to firms that have applied for a loan. So firms with no bank debt that really wants to obtain financing. And you see that, okay, so the sample changes. What happens if the firm had bank debt? It could be the same. It could be, I have bank debt, but you are comparing it to me, but I didn't apply for a loan. Here, we restrict the sample, you see again, almost half, to firms with bank debt that either has applied for a loan, or they have a lot of short-term debt. You remember the paper yesterday? And in this case, these firms are very likely to apply for a loan in a bank. So we are comparing firms that demand credit. So in the placebo exercise, for the pill, I take people that are 90 years old and I compare the reaction versus people that are 20 years old. And I give the treatment to people that are 20 years old and I say, this is effective, all the other die.
Some die and some
Exactly. It's because of the pill? No, it's because of the sample selection that I'm doing. So when you run this regression, you need to use firms that are comparable, okay? And with this, I stop. You see that still there are differences. The differences are persistent. Even if I consider firms that apply, they are different, which is good. But will you stop here? No. If you stop here, you are comparing firms that demand, but they still are different.
Sorry, I'm trying to understand this graph. So for the zero bank debt firms, you check if the website, the database,
The credit
to
register.
see
If they apply,
and those are the only ones that you selected.
Yeah.
The one who didn't apply, you just do
I don't
it,
use
right?
it.
And then you compare them to the one who already have
Exactly.
or happy with that.
Exactly. So this is a new paper, a new methodology. More people are using this that we applied here because this was the first time. I mean, people usually use firms with bank debt, and then you can use the specification that I explained yesterday, the log change in credit. So what happens here if I look the log change in credit? So what is the credit at time t? Fine, this is positive. But if I take the difference with the credit at time t minus 1, which is the credit of zero bank debt firms a year before? 0. Okay? 0. So if I compare firms with no bank credit, this is going to be always positive, no? But firms that don't have bank credit, the ones that don't increase the credit, it could be negative. So the effect that I obtain if I use the credit is not going to be given by the new credit. For the firms with bank credit, it's going to be given by the repayments or the amortization that they do of the previous credit they have. That's why I don't use it. And the last thing, and then we stop here, sorry for that. It's because of the 20 minutes that I was waiting for the seminar. The next thing is, fine, I mean, now you are comparing people that are 20 years versus 20 years old, and you gave them the view. Because all of them demand credit, all of them are young. They continue to be different, because now you are selecting people that are 20 years old, some of them smoke, and some of them practice sport a lot. And then you tell me that the treatment is effective because you are giving the treatment, the pill, to the ones that are practicing sport. We do this something more so. And I'm not going to enter in details, but I want you to know. So when the sample is not comparable and there are differences, any referee, any person can tell you that the difference that you find is because you are comparing things that are different. example. So in the previous video, in the parallel trends video, it's like if I have this is the treatment, and I have something that is, let's say, like that, and it continues decreasing, and the other one is increasing, and it continues increasing. So the difference existed before. So the trend, in some sense, existed before. So in order to deal with this, we use something that is called, in the paper, propensity score matching. Okay? This is propensity score.
That's like a way of clustering, no, prof?
Sorry?
That's like a way of clustering, let's see, score match.
More or less. Do you know, have you heard about the neighboring treatment? So you wanna compare it with your closer neighbors, no? That's the same idea. And there are many ways to do that. I just give you the concept. What I mean, when we did this, I was expecting, that was my wish, that after imposing the requirement of firms that demand credit, they are comparable. So if they are comparable, I stop here. But given that they are not comparable, I have to make them comparable. How? Using this technique. So what this technique does, in some sense, is to use each firm, and they find, I mean, this is a command, it seems very difficult econometrically. I'm not going to explain the econometrics. The econometrics are very important to understand what you are doing, but when you go to the statistical packages, it's one line. You write one line and you are. So I want you to understand what we are doing, and then you write the line. So the propensity score matching in a state type that is something like P-score or something like that. You can write L, P-score, and there are many ways to compare the firms. What it does is, for each firm, I'm going to use a firm that is comparable. That's why it's called this Mahalanobis distance between them, the neighbor, similar neighbors, and so on. So the point is, I need to compare firms that are identical. So for each firm, with these characteristics, I'm going to find a firm that is similar to it, and I'm going to compare the two firms. Right? So I'm not going to use 20 years old guys that smoke versus other ones that are very active in sports. I'm going to use the ones that are very active in sports, and I'm going to give the field to the two of them. And in order to do that, they need to work. So I mean, working with data means that you need to do. I mean, it's not that I run the regression and I forget. You need to see the data. You need to see a statistic. You need to compare them to understand what you are doing. And there are many ways. The one that we use here is very simple. In the paper, we have to do like 8 methodologies of this propensity score matching. The referee told us to do 8, and we did 8 alternative methodologies, and we created 5. I mean 8. So, but with a simple one, we have the result. The point is that we are comparing firms that are similar. So after imposing the propensity score matching, the difference that you observe here disappears. Of course, the cost is that the number of firms that I'm using is much more. So when you do this, first of all, you show in your paper, in your master thesis, look, these are the results that I obtained when I use the whole sample. And someone can tell you, yeah, but have you validated the parallel trends? They are not comparable? Fine, but I show you that if I use the mix of 90, 80, whatever, there are differences. Then I show you what happens when they demand credit. They are the same. And then when I use the propensity score matching, they are still the same. And then keep working. Okay? The point is, don't start with the simpler way, but don't show also the last one, because if you show me the last one, in the process of the propensity score matching, I can select the firm that they want, and then the result will be different. Okay? So be always transparent when you do this. Show everything. Okay? And then we stop here.
Sí, yo no soy muy elocuente, la verdad, para hablar ahí enfrente.
Yo ya me pongo un poco nerviosa, me voy a poner un poco nerviosa porque era nerviosa y eso, pero...
¿Te vas a arrancar los dedos?
Sí.
Me ha venido a la cabeza lo que les he hecho a mis hijos para los chichones. ¿No habéis visto eso? Me ha venido a la cabeza. ¿No habéis visto a los niños para los chichones? Se les
Te
echa
ha hecho daño, ¿eh?
mucho daño. ¿Un chichón?
Ni me voy a preguntar a ver si
No.
me algo...
Pero a los niños cuando se hacen chichones se les da una, ¿no he visto? Un rolón, una pomada.
Sí, esa la tenía yo.
Ese, pues estaba pensando en esa.
Isabel la sí, pues te la voy a echar donde...
Sí, no. Se han pegado.
Sí, a la más que esos golpes...
¿Raúl está
se
vivo?
te pone así, ¿no?
Sí, está vivo. Y fue a romper tu cuerpo.
Más grave que el mío, ¿no?
Y él se iba de espaldas, así como.
Wow.
porque le gustaba caminar de espaldas hacia atrás. ¿no?
Por lo
Sí,
menos no lo
sí,
ha visto,
verdad.
por lo menos no lo ha visto toda la clase. No lo
No,
contéis.
pero la verdad que está muy mala altura.
Es que está, o sea, es como una extraña que no la haga. No, fíjate que estaba hablando de la ventana y me
¿Dónde fue?
claro.
En la otra, en un seminario nos dijeron que no se podían abrir correr como ahora.
No lo entiendo. No tienes que haber dicho. Nos tenemos que poner casco aquí, ¿no? Para la clase. No puedes, es que.
Sí, sí, ya va a salir muy bueno.
No, no sé.
Aprovecha y se hace millonario, pues no tengo de más.
Con la. No. Yo quiero luchar la uni esta como para.
Sí.
Sí.
¿Usted se graduó de acá?
No me. O sea, fíjate, yo me gradué estudié en la Carlos III y en el CENFI. Pero entonces aquí vine en 2012, vine con vinimos los dos contratados aquí como profes. Y o sea, yo me fui con mucha pena porque bueno, la familia estaba en Madrid, estaba o sea, Banco España que tiene todos estos datos y me permitía hacer mucha más investigación potente, pero me dio mucha pena, la verdad. Es que no sé, o sea, lo habréis visto, no sé si alguna vez estudiado aquí o habéis visto el ambiente y tal. Pero es que el ambiente es.
Pero un poco chica, ¿eh? La ciudad.
La ciudad es pequeña, claro.
O sea, es más chica que yo lo pienso y es más chica que Córdoba. Y Córdoba para mí ya es pequeña, ¿sabes?
A ver, o sea, Pamplona tiene cosas, no sé, o sea, digo que o sea, más allá de eso, o sea, yo he dado clase en muchos sitios, ¿no? Y pues en Madrid, el año pasado estuve en CUNEF, en un máster parecido a este, o sea, ya no se trata del sitio, se trata de, o sea, en el IE no di una, al final la dio María, en la Carlos, o sea, los alumnos, los compañeros, los profesores que te encuentras aquí no están en ningún sitio. O sea, decir, más allá de que, es que el máster es muy bueno, porque sí, vale, bien, pero yo no di clase en CUNEF el año pasado, o sea, me gustó, estuvo bien, pero, o sea, yo estoy hoy de vacaciones.
Y ahora
O sea, yo
no,
utilizo mis vacaciones para dar clase.
¿Qué notaba uno de diferencia entre profesora y
O sea, los alumnos, por ejemplo, yo siempre lo he dicho, lo mejor de la Universidad de Navarra son los alumnos, o sea, con diferencia. Hay dos cosas, o sea, el Santísimo y el Oratorio, que no está en muchos sitios, que eso es lo mejor que tiene la universidad, la facultad, y los alumnos después. Porque no, pues, o sea, como que no sé, o sea, primero es el respeto que tienen aquí, siempre, desde que tienen 18 años los chavales, aprenden el respeto y entonces lo llevan a cabo, están donde están, entonces muchos tienen, ¿sabes?, una formación y segundo, pues que quieren aprender, o sea, en otro sitio, estoy de prácticas, y cuando iban a clase o no iban, te contaban unas milongas, es que no podía venir porque tal, pues si yo no te, ¿sabes?, no me mientas, o sea, si no puedes venir, entonces aquí es todo como mucho más humano, más cercano, más respeto, más, o sea, yo daba clases en máster de banca de Madrid, un montón, lo que pasa es que eran 5 horas y 5 horas, un día 5 horas, sí, un día 5 horas y otro 5. Yo no tengo mucho tiempo, ya digo, yo hoy estoy de vacaciones. O sea, he tenido que pedir vacaciones, no es que no me dejaran, pero sin vacaciones ya. Entonces tenías
trabajo en sí en el Banco de España.
Sí.
Y todo es ya como alternativo porque te gusta.
esto lo hago porque me gusta, porque lo paso bien y porque, o sea, pues claro, ya que son unas cuantas horas y tal, por los sitios de tal pasas bien. O sea, no son. Entonces, aquí los profesores ya lo habéis visto cómo son los profesores, son por vosotros, los cuidan, los asesoran, están muy pendientes, hay de todo, ¿no? Como en todos los sitios. Pero los labs, uno está ahí, aquí la luz no se ve, no tiene todo. Sí, tienes eso, se nota, o sea, mucho, ¿vale? Y es eso, para que también pedir consejo a los profesores, a los colegios, puedo hacer ayudar,
Qué guay, ¿no?
hay una conexión que ahora es una
¿Cuántos han cobrado?
So, propensity score match. Natalia and Lucrecia was asking about a potential rule in order to design the sample, no? In the sense that you cannot have 10 observations in one sample and 1 million in the other, of course. That's not, but there is not a clear rule. I was saying that here, for instance, you have almost 4 firms here for each firm here, right? And that works.
With overlapping, no? You can see it with overlapping.
I mean, if you have the same number of firms, that's perfect. So, but suppose, I was saying Lucrecia that suppose that in this table the two firms are comparable. I mean, the p-value is above 0.1. I stop there. So I don't apply propensity score matching. They are comparable, I stop. Here they are not comparable, so I need to use propensity score matching. When I use propensity score matching, the firms that I want to have in the two samples are more balanced, because there are many ways. One way to do propensity score matching is to match a firm here, a firm that is exactly the same in this sample. Then you have 1-1. Notice is one firm here, and you can this P score, you can define this. You can say I want one firm here, and I want to have 3 firms in the control group, or 2 or 5, whatever. Okay, and you can design the sample. And then you can, again, I mean, it's not. I cannot give you something that is always valid or always useful. So, I mean, some many cases it's just common sense. You can say I use 2, I use 3, I use 5. And then you see. And something important, when you use the propensity score matching or other type of methodologies in which you choose firms randomly, if you run it again, the second time probably the number that you get is not exactly the same. Because you are choosing firms again randomly. So in some cases you need to fix a seed or you need to fix something to guarantee that the firms that you are using are the same. Okay? So it doesn't mean that you are going to get always the same result. No, probably the coefficient changes because the program assigns randomly other terms. So what is important here? So some of the zero bank firms that I was saying are constrained. This is what we have seen at the beginning, right? So the firms that I'm using are firms that are really demanding credit. What I've said in the second table. How can you do that? I give you the 3. So one is firms that apply for new loans, and then you can tell me, yeah, but I don't have a credit register. So how can I restrict my sample if I want to study credit supply, if I don't have a credit register and I don't have information on whether they apply or they don't apply? For the firms that have bank debt, again, the ones that don't have bank debt, of course you can do this analysis. But for those with bank debt, if you want to control by demand, you can use the firm time fiscal effects, or you can go one step forward and you can say, for instance, 25% of the debt matures in 1 year. And what we have seen in this data is with the very simple rule, you observe that 78% of the firms that have more than 25% of the debt maturing in 1 year apply for a loan the year after. Because they need to renew the loans, no? They need to roll over. And this is a very simple way to say, look, I mean, I guarantee that firms demand for credit. Something happened in the break like that. You would not say. The window that is. So 25% have short-term credit and they demand new credit the year after. So this is a very simple rule. Then, as I was saying, given that we have differences, we use propensity score matching. And once we use the propensity score matching and have a sample of firms that is balanced, I run the linear. Okay? Okay. The next thing, the important one. How do we study the access of zero bank debt firms to credit? With a difference in difference analysis. Okay? So, again, this is empirical banking, but I want you also to explain econometrics, because to do something empirical, you need econometrics. So, first session, we learn how to estimate credit supply from a regression, no? The key is bank firm time data, and we use firm time fees effects to control by demand. And with that, we can isolate credit supply. Second econometric technique that is very important, difference in difference analysis, the one that we are using today. Okay? First day, standard log changes, controlling by demand. Today, difference in difference. Okay? We are going to use this a lot. What is a difference in difference? What I have explained there. But now with a regression. How do we translate it to the regression? Okay. The dependent variable is whether the firm demands for new credit or not. Sorry, whether the firm have new credit or not demand. All of them demand. Okay. First question that comes to your mind. I mean, you have bank firm time data. Why don't you use bank firm time data and you use firm data? Data at the firm level. So here I don't care about who is lending to the firm. Why? we are focusing on the extensive margin, whether the firms obtain credit or not, but they can study the extensive margin using bank firm time data or just firm time data. Why do you think that here I focus on firm time data and I don't consider the bank dimension?
Because they have zero debt.
In the sample, I have firms with zero debt and firms with debt. But yeah, for the firms that don't have bank debt, I don't have information on the bank before. So they start having debt. This is one explanation, no? And this is important. For the firms with bank debt, I can use the log change, what I have explained before, and it will be something positive. I can change with something that is higher or lower. With the bank with zero bank debt, it's zero at the beginning and then something positive. But more important, I have a sample of firms with no bank debt, and for these firms with no bank debt, I don't know the banks to which they could have applied before, and importantly, for this firm, they apply to one bank. So it's not common that a firm has positive debt and they apply to many banks. So how many observations would they have at different level? One. Right? For the firm without bank debt, it's not that they apply to different banks and they obtain credit into different banks. For the firms with no bank debt, it's equivalent to having one observation. Firm time. Firm bank time, yeah, but it's one bank. They don't apply to 11 banks. Or they don't obtain credit suddenly from 3 different banks. It means that there could be a sample of firms with previous bank debt that probably they have relationship with more banks, and firms with no bank debt will have a relationship with one bank. And then when you see this, the evolution of credit of the firms with no bank debt will be much higher because it's a single bank, and in the other one you will have something positive if they obtain credit, negative if not, okay? And that's why we collapse at the firm level.
Yeah, I was trying to.
But all of them only apply to one, like only request a credit to one bank, for sure.
The firms that don't have bank debt, I don't know, 70% of them, they don't go from zero bank debt to having bank debt in 3 banks. Usually it's no bank debt, and then I see bank debt in a single bank. Okay, so that's why I have to for these firms, 70% of them is the same. I would have one observation. The other ones, no, but
You take the first bank.
exactly. But take this, no? 2 firms are the same. One needs a credit of 20, and then you see the difference would be 0, 20. A firm with 4 banks would increase probably in one bank from 10 to 15, in another one from 10 to 15, 10 to 15, and in the other the rest. When you take the average, the credit growth of the one which goes with a bank is going to be very large, and in the others, even when they obtain the same amount of credit, it's going to be low. It doesn't mean that they are not obtaining less credit. It means that they spread the credit in different banks. Okay, so we do it at the firm level. Sometimes you can do it. It's not that, depending on what you want to study, it's not that I learned this methodology and I'm going to apply this for everything in banking. Log change. No, here it does not make sense. Because the initial point is 0, and because of these things that they do. And this is a difference in difference. Okay? So look, the treatment is what? The people who got the effective P are firms with no bank debt. First coefficient of interest. Second coefficient of interest, the interaction of the post-COVID. So the point in which I deliver the P to the people is here. This is the COVID. I deliver the P here. This is post, and this is a dummy that is equal to 1 after the COVID. So the point in which I deliver the pills to people is this, no? Post-COVID is equal to 1 for the period after COVID. And then I use the interaction of post with the treatment, the no bank debt.
That's the change in the slope, right?
Exactly. Why I'm not using here firm time fixed effects? Look what I'm using here. Industry, location, size, time fixed effects. The combination of what I have explained at the beginning. Why I'm not using here firm time fixed effects? If I use firm time fixed effects, what can I estimate from them? This is at the firm time level.
It blocks it kills the.
Everything.
Yeah.
No? Because bank debt is firm level. So I'm considering whether they have bank debt in 2019 or not. So this is at the bank level, the treatment, no? The firms, the people that get the key. And the other is time interacted with firm, so firm time. So if I use firm time fixed effects, it kills it. What is the solution? Look, I'm controlling for demand, no? Because bill regression is done only for firms that demand credit. So I'm controlling for demand. How can I control for demand even larger? They can say, yeah, but they demand credit differently. You see this because of the problem with the window. I forgot the clicks. What is this? I don't remember. Well, the end. Okay, I like it. So the end. Industry location, size, time, fixed effects. I'm using the fixed effects of all of them in order to further continue for demand, right? Further continue controlling for demand. So the assumption here is, look, you are using firms that demand credit, but probably the intensity in which they demand credit in COVID is different, because the firms that are in sector related to tourism demand credit very differently as compared to firms that are, I don't know, producing a mask, of course, no? But then I use industry, location, size, time, and I'm comparing the new credit obtained by firms that are comparable in terms of the industry, location, size, and time. And then we use the firm controls, okay? And we use the firm controls lagged one period, right? Before the COVID, because if I use the firm controls after, okay, it will be look ahead bias. Okay, I lag the controls. So you can run the standard different analysis without controls and without fixed effects. This is the standard one, the one that gives you the average effects. Okay, look at this. Yeah, I'm going to write it. So the standard different analysis is what? Is the new credit firm. The coefficient, let's say beta 1 zero bank debt. Firm F plus beta 2 times cost. If you learn this, you have a lot of to do research, because many people now study the different. I mean, now there are some papers dealing with the limitations of the differences, especially when there is something that is called a staggered different. Now, for instance, I use suppose that the shock is a fire. I have a paper on fire that I will explain later. If the shock is the fire and there are firms that are affected by fire several times, no, it's like you give the pill, I mean, which is the effective one. The first one that you give the pill, the second, the third, okay? And you need to control the risk. And then the third coefficient of interest is the cost interacted with the zero bank and the firm, plus the risk. This is the standard difference. So what is this coefficient given to me? The difference. These are dummies. These are dummies. This is 0, 1. This is 0, 1. This is 0, 1. That's why this is difference in difference, because with the difference in difference, you can run the regression, or you can take the average and take the differences between the average, and you will get exactly the same. So what is this one telling me? This is saying me the average probability of obtaining a new credit by firms with zero bank debt before COVID. Okay? This is the average.
Why before COVID? Are you using every?
Because cost is not used here. It's the same reasoning as yesterday. Okay? So there are three differences here. That's why differences in difference is this coefficient is the one that tells me the differences in differences. Okay? So the first coefficient, this beta 1. Beta 1 compares the probability of obtaining credit by firms with zero bank debt before COVID, because here they don't have the cost, and the firm is the same. So these are the person that goes to the hospital. I mean, what was the, I don't know, how were you, depending on whatever variable you want to consider before the pill. And this tells you, this is the first difference. It tells me the difference between the firms with zero bank debt and the firms with zero bank debt, without zero bank debt, so with bank debt, sorry, before COVID. This is the first difference. Can it be significant? Yeah, I mean, they could have a different probability of obtaining credit before COVID. Is it bad? No. It's telling me that they are different ex ante. What matters is that the difference doesn't change. No? Here it's very simple because I'm using one observation before, one observation after. I collapsed. But suppose that I have a lot of years. What is important is that this difference is the same over time. Right? So it's not that as COVID approaches, the credit that they obtain goes like that and the credit goes like that. I mean, there are differences, but it started before COVID. It was not due to COVID. No? So what matters here is that if this is like that, this one has to be parallel. So the distance here is the same as this one. But the fact that this is significant does not invalidate my analysis. It just said they were different. Fine. This is the first difference. The second difference is this one. What does difference says? This post.
The difference in time
Between
the pre-COVID and after COVID.
for all the firms. Exactly. So this is the claim how it evolves. Suppose that after COVID, all of them, I don't know, all of the two of them jump. It comes here and it comes here, and it's flat. I mean, the post tells me this difference for this group and for this group. The second difference. After COVID, there is a difference in the probability of obtaining credit by firms. Doesn't matter the type. And it affects the two of them. And suppose there is a policy like the public guarantees or whatever, the two of them obtain more credit. Fine. And this one is the difference, because this one is telling me the difference in the probability of obtaining credit after COVID by firms that have zero bank debt. That's why it's called difference in difference. So this specification is the same as if you do the average for this variable for the two groups. No zero bank debt, no. The zero bank debt. Esto es before COVID y esto es before and then think about the difference like that. You take the average here, let's say 10, whatever it is, you take the average here, you take the average here, and you take the average here. This beta 1 tells me the difference before COVID, no? Of the firms that have zero bank debt. So it would be 0, it would be the beta 1. So before COVID, they are not different. Right? The other tells me, the post tells me the average here versus the average here, and it gives me the difference. And the beta 3 tells me the difference between these two, so the beta 3 would be beta 3. So the difference between the
10 minus 12.
10 minus 12, exactly, and 20 minus 10. But then it takes the difference between the 8. Okay? Suppose that this one is 12 as well. Beta 3 would be 0.
What if it's that effect? Isn't it only because isn't it the difference between the zero bank debt firms before and after the
No, look, this is a dummy that is 0.1, so it's telling me the average as compared to the other. So you told me that here, this beta 1 is not this, because it's a dummy variable. It's compared to the control, to the value of reference. So in the before, you compare before this versus this, and this tells me 0. There are no differences. In the post, you are comparing, I don't know exactly, the 10 plus 10, the 20 plus 12, and then you take the difference for the two groups together. This is the difference in the post. And for the beta 3, you use the difference in this one, the difference in this one, and the difference. That's why this is difference in differences.
So, the interpretation?
So in the post, in the third value variable, or yeah, the interaction between the post-COVID and the zero bank debt, it would be given 1 in case there is, in case there is bank debt. So when will you give a 1 to the dummy variable?
This one?
Yes.
Okay. When it's, it's equal to 1, when this is equal to 1, and when this is equal to 1.
So,
Okay, so the variable of reference here is what? Is zero bank debt in the post. We are comparing this 12, right? But in excess of what? In excess of, you have to consider what happens before and what happens for the friends with zero bank debt before COVID. So that's why this is difference in difference. Because it tells you the difference for the after the COVID for the friends with zero bank debt. So there are two differences. That's why I got this table here, because there are two differences, right? One is the difference, the one that you told me, this is the first difference, the first div, and the first div considers, okay, tell me how it evolves credit within this friend, the pre and post, no? And the second difference is that once you have told me how credit evolves pre and post, tell me the second difference between the two, okay? And that's why this is difference.
So the interpretation of the first one is the average probability of zero that banks to obtain the credit, right?
Before COVID.
Before COVID, yeah. And then you have the one with post-COVID, and then
Exactly. Exactly. So this is the standard definition. I can do this table here, and I'm going to get exactly the same as in this regression. So the first difference, here in this regression, I'm using friend controls. So if I use friend controls, you cannot translate directly the average to the coefficients that you estimate here, because you are using friend characteristics. And there are some differences. Okay? And the last one, why I cannot use the post in the specification that I have in the slide. Why I cannot use this? This is not correct. Why?
Fixed effects.
Because in the fixed effect you have industry, location, size, and time. Given that you have time, I cannot
that
estimate.
control. The ILSP gives that control, no? Like 60.
It's an estimate. Does it matter? No, because what interests me is this one. The changes after giving the P to the purpose. Okay? If you don't use these fixed effects, you can estimate it. It's useful. You could see the average amount of credit to the two group of firms after that. This would be the credit to the firms in which this is what? This is zero. So the firms to the firms that have none. I don't care, I want to see the difference. Okay? And these are the results. So the first column. In the first column, I'm not using that difference in differences. I'm just showing the coefficient that I obtained for the zero bounded firms. And it tells me, during the whole period, during before and after, the probability that a firm with zero bounded obtain a credit as compared to firms with bank credit is 8 percentage points lower. So it's significant. Again, this is for the firms that demand credit for the match sample. In the second column, I'm using the difference in differences. And then I'm saying the average probability before COVID is 6.6 percentage points lower, and in the post is 2.3 percentage points additional lower. Which means that firms with no bank debt obtain less credit before COVID, but this difference exacerbates during the COVID. How much? 2.3 percentage points. Additional, yeah. So this is what I explained yesterday. So in the second column, if you want to see which is the probability that a no bank debt firm obtains credit in the pre is that the total probability that a no bank debt firm obtains credit in the post is 0.66 plus 0.023. It's the sum of the two. So the 0.023 gives me the differential effect. Okay? Fine? What I told you yesterday, semi-elasticities. I mean, it's difficult to compare these, no? I mean, what is that? 2 percentage points, 6 percentage points. A common problem for you when you run the regression is that you mix, in some sense, the interpretation of percentage points and percentages. You know the difference, no? It's not the same, and this is very common. I mean, something is percentages and the other is percentage points. In this case, we are talking about percentage points. You take the difference of a ratio. The difference of a ratio is something that is in percentages minus something that is in percentages. The difference has percentage points. Okay? Be careful with that, because it's very common and it's a very bad thing. So here I'm showing the semi-elasticity in order to compare the pre and post. You can tell me, yeah, it means nothing, but how we do it? The semi-elasticity takes into account the coefficient that I estimate and the average probability of obtaining of being non-market terms over the average of the dependent variable. What I explained yesterday. In that case, you can compare whether the magnitude is high or not. And you see that look, this is minus 0.136 and this is 0.08. Why I'm using the semi-elasticity? Because in the last two columns, I split the firms into groups. The safe and the risky ones. And the point here is, fine, I mean, probably related to the risk, no? Probably the banks are not lending to these firms because they are risky. And the answer is, okay, so then let's compare firms that are safe with firms that are safe and firms that are risky with firms that are risky. So in the previous example, let's compare not just the guys that are 20 years old and they practice sports. Let's focus on the guys that don't take a risky life versus those that take risks every day. And then you see that for the safe firms, the differences with no COVID, in the pre-COVID period, they exist, but they are much lower than the risky ones. You tell me, you are comparing the coefficients. No, I'm comparing the semi-elasticities, is 0.075 versus the 0.238. Because in both cases, I'm multiplying by the average of the explanatory variable, and I divide by the average of the dependent variable. And then I can compare. Even when the samples are different, I can use the semi-elasticity to compare. You remember, no? I multiply coefficient times the average of the explanatory variable relative to the average of the dependent variable. So what happens during COVID? This is very nice, because during COVID, the drop in credit in the safe firms was higher than the drop of, relatively higher than the drop of credit in risky firms. Because the risky firms were not obtaining credit before COVID. So COVID comes and they obtain even less. But they were constrained before. The problem is with the safe firms that were more or less the same, and with the post-COVID, the effect is comparable. So the probability of obtaining credit decreases a lot. So this is a problem. This is what I told you before. So it's not that they are not given to the risky ones, fine. It's that the safe ones, the good ones, were not obtaining credit because there is not hard data, hard information going back to the theory for these ones. Okay? To be clear that was okay. So this post is not interacting with the zero bank debt firms. So it tells me the probability of obtaining a credit after COVID for firms without bank debt. Okay, so it's not a difference for the two firms. It's post is not multiplied with zero bank debt, so it's for the firms that have bank debt. Okay? So in this example would be the difference here as compared to the others. Okay? It's tricky, right? But that's why this coefficient is useless. The important one is this one. Okay, the difference in difference. The difference between this one before and after, 2 and 10, and the difference between the two. Okay, very important. Okay, so the next is what I have explained here. So you have the explanation. The next point is, what is the role of collateral? So if there is problems, there are problems of what? There are problems of hard data. There is no hard data for the firms without bank credit. We don't have it. Soft information, pure, right? We don't know much. How can we mitigate the problems of asymmetric information? Posting collateral. Okay? And this comes later in the theory, but that's why you see here that it's connected to what it comes now. The probability of obtaining new credit, this is just for the post period, okay? Why it's for the COVID period? Because the personal guarantees, the public guarantees, didn't exist in the pre-period. So if I consider the effect, it's going to be driven by that. Because the ICO, the public bank, was not giving guarantees before COVID. So then I need to focus, this is not a difference in difference. Here, I forget about the pre, and I just, this is post is always equal to 1, and I just estimate this coefficient. You see, no? So it's a difference. The difference in the post period. I don't consider the pre period because there were no guarantees. So the probability of obtaining credit for the firms without bank debt in the post is 0.67. This number corresponds to say firms, these ones here, and it's roughly the same of the two, okay? Because the same of the two gives me the probability that zero bank debt firms obtain credit in the post, no? So it's the sum. And that's why that the coefficient that I obtain here, I focus in the post, is similar. What happens if I focus on credit with collateral? What is the difference? With collateral or personal guarantee, that is the collateral that is given by the firm. So the firm could give collateral, or the government can give collateral. This is what I have here. So when there is collateral, what happens with the probability? Still, I mean, it's different, but what happens with the probability is much lower. Okay? And you see here that when there is asymmetric information, when there is no good information on firms, which is the effective way to mitigate the problems that they face to have access to credit? Posting collateral. In the fourth column, the collateral is given by the firm. In the last column is given by the government. If you focus on the coefficients, that's why I explained this yesterday. If you focus on the coefficients, you can say, wow, 0.67, 29. This is much lower, no? But I told you that when the samples are different, it's tricky to compare them. What happens if I obtain the semi-elasticity? Flat. This is more negative than this. So here I'm saying you don't have a credit, or you have a credit with personal guarantee, with the firm guarantees. In this one is you don't have a credit, or you have a credit with government guarantees. Look, this semi-elasticity is much lower. So what does it mean? If you focus on the coefficients, you tell me something. If you focus on the semi-elasticities, that's why you cannot compare directly with the coefficients. The result is not exactly the same. Why is this? So during COVID, you go to the bank and you say, look, I'm going to offer you a personal guarantee. And the bank tells you, fine. In these days, who believes the guarantee that you are posting to me? It was very difficult to value the personal guarantees at that moment, no? I mean, you were offering as a doctor and say, look, I offered my guarantee, no, in the peak of COVID. I'm a doctor in the hospital. Oof. I don't know. Your salary is good, but probably that guarantee is, even when you deposit your salary, whatever. And that's why this effect is more negative than this one. Because personal guarantees were not useful, but when you consider the government guarantees, it decreases. So one solution to help these firms to have access to credit is to have public guarantees. And this is why the Spanish public bank, the ICO, the one that I said at the beginning, one of the programs that they are considering to design was specifically for these firms. We are collaborating with them in the sense that I offer guarantees to firms that don't have bank credit, so they believe this paper, they say, look, we believe it. And we see that we are effective. And they are considering to design a program, first of all, like an experiment with a few firms, to provide credit to firms without bank credit, to see to which firms should we offer a guarantee, whatever. In some senses, in this financial integration, whatever, is to put these firms into the financial system. I'm not saying that they need to have a lot of debt, no. I'm saying that they need to have contact with banks in order to money when they need.
But I don't get how you schedule and that's like how I understand the last part, but I don't get how even though it's not as good as the credit of public guarantee, how come a company with personal credit has even less probability of getting the credit?
Because here I have all the credit. Right? So in this specification here, I have credit, new credit,
Yeah.
0, 1. So it's a mix of everything. So this is not the same, but this is like a weighted average in some sense of this semi-elasticity and this semi-elasticity. How many observations you have here? 83. How many observations you have here? 57. There are many cases in which there was personal guarantee given by the owner of the firm and personal guarantee given by the government. But here I don't distinguish, I use all of them together. So you cannot compare directly this with this. You have to compare this with this.
Which one of the interpretation of the provision for semi-elasticity?
Okay, so this semi-elasticity is the product of the no band depth with the average proportion of firms with no band depth, that is the average of that variable, relative to the average of the dependent variable. In this paper, I think that we even don't take the average of the dependent variable, because the average of the dependent variable could be this dV here, right? Suppose that it's negative, it's very close to 0. So consider that the semi-elasticity is the product of the coefficient here, the 0.067 times the average of this no band depth. And you can do it relative to the average of the dependent variable or not, depending on the specification, or on the standard deviation of the dependent variable. You can do so. My point is, in this column, I'm using all the firms. They obtain no credit or they obtain one credit. This credit could be with collateral, without collateral, with collateral from the manager, with collateral from the government. And this is the semi-elasticity. In this column, I'm using firms that do not obtain credit or firms that obtain credit with collateral given by the managers, personal or real. The firms that obtain credit with public guarantee or the firms that obtain credit without collaterals are not using this relation. And in the last column, I'm using firms that do not obtain credit or firms that obtain credit with a public guarantee from the government.
What's public versus personal guarantee? Just want to understand the
Public is the government, is a guarantee given by the government, the example that I explained before.
just a given line.
And personal, no. Personal is a guarantee that is offered by the person who asks for the loan.
Even like any collateral, like buildings or anything like
I'm not splitting. There are two types of collateral. So personal collateral or real assets. Okay? So you have the guarantees are like that. You have the personal and you have the public. The personal are called collateral, when it's a house, financial asset, whatever, and we call it guarantee. Okay? And then it could be private guarantee, public guarantee. And it could be collateral or personal, and this is public. So in this column, in the second column, I'm using just this and this, all the two together. There are differences between them, and I will explain it in a later paper that I will explain to you. There are differences. Personal is your wealth, your current and future wealth, your salary, the stocks that you have, the deposits, your housing, whatever. Collateral is when you use your house, financial assets, but a specific house for specific financial assets.
¿Cuántos necesito de guarantee? ¿Cuántos datos?
Public guarantee is the one given by the government, the example that I said before. The government says, look, if the borrower does not repay the debt, I'm going to take 80% of the losses. And the government gives to the loan, to the bank, 80% of the losses of that loan in case it doesn't pay. Up to 80%. So if the default is for 50%, the government gives 80% or the 50%. Okay? And the difference between these, I will show you a paper later on collateral, and the difference is very important. Because collateral is an asset that is priced today, so my house, blank, collateral. The personal is your present and future wealth. And this is very important. That's why when you use personal guarantees, a company that is limited liability, when you use a personal guarantee, it becomes unlimited liability. Because you respond with everything. So the idea of a limited liability firm is that my liability is limited to the firm, no? If you use a personal guarantee on a loan to your firm, it's limited. Okay? And that's the difference. The difference here is that why are the differences between the two that I was using there and the public? Because during COVID, the value of the personal one were much lower than the one of the guarantee given by the government. And then, what time is it? Okay, so we have some. So the last point is what happens with the firm exits. We run similar defensive analysis, but now the dependent variable is equal to 1 if the firm exits the market. And we want to see the probability that firms with no one debt exits the market before and after the COVID. Here it's a bit different, right? Because the exit is a dummy that is equal to 1 in that period, right? For the pre. I'm going to use a longer period, otherwise I don't have exits. And for the COVID shock, it's equal to 1 if the firm exits the market, not just in 2020, because it's not that COVID comes and firms say, look, I stop producing or I leave the market. And that's why I give more time. So when you do the paper, you need to understand the characteristics of the variables. So it's not that the firms stop in April. Some of them did, but given the public aids that they obtained, they continue producing. And that's why here, instead of considering what is happening just in 2020, I consider 2020 and 2021. Okay? And for the pre-period, it's not just 2019, it's 2018 and 2019. That's why the no one debt is slightly different, because in the other one it was between 2014 and 2018, and now it's between 2013 and 2017. Okay? It's always before the period of the concept. That's the thing. But it's always the same. And the dependent variable is whether the firm exits the market. And what happens? If you see the first coefficient, the probability of the firms with zero bank debt exiting the market in the first column is statistically significant, but look at the coefficient, it's 0.001. But the probability that a zero bank debt firm exiting the market during COVID is 10 times larger. You can tell me, yeah, but probably these are the risky ones. I mean, of course, the risky ones have roughly the same probability of exiting the market before, a bit lower when you split, and this is because of the fixed effects that we use, don't worry about that, is roughly 0. But during COVID, the probability that the risky firms exit the market is much higher, 2 times higher than in the previous one, and you see the semi-elasticity you can compare. But importantly, the probability that a safe market exit the market, that a safe firm exit the market increases a lot during COVID. So which means that banks were not giving credit to zero bank debt firms, and the consequence is that the probability of leaving the market increases significantly. And in the last column, you can tell me, yeah, I mean, they don't exit the market, but this is because they have losses before. And then I restrict the sample to firms that have positive return on assets, in the sense that they were having profits. So it's not that they are leaving the market because they were coming from a bad situation in which they were having losses. So only firms that are having profits. And you still see the same, there is a huge increase in the probability of exiting the market. Okay, so it has consequences. The consequence is that we anticipated and that I have said at the beginning. So they need financing, they do not pay financing. The point here is what happens if they would have obtained credit? Because here we cannot see that this is due to the fact that they do not obtain credit. They do not obtain credit and they exit the market. How can we merge? I'm not going to put the words in. How can we merge the two conclusions? What do you think?
Can you repeat the question?
I have shown you before that zero bank debt firms didn't obtain credit. And secondly, I have shown you that zero bank debt firms exit the market. So the point is, how can I connect it?
With an interaction
Yeah, but the interaction of what?
of a zero bank, debt free, exit, a zero bank.
I mean, this is a common response, eh? My point is, sometimes don't think about interactions. When interaction means a lot of interactions, 3 interactions is a lot, because you have to explain that with a matrix. It's not a table. 3 interactions in many cases is a lot when you write a paper. You can condition the sample. And this is an idea. I mean, you can restrict the sample to what firms? Zero bounded firms, fine. I focus on zero bounded firms. Comparable. How can I see whether it was due to credit? I focus on zero bounded firms and I see, okay, so what happens with those, just in the post period. You see? So your idea was the same, but much more complicated. Because your idea was, you can interact this with a dummy, denoting whether they obtain new credit or not. But with that regression, with 3 interactions, I will tell you what happens if they obtain new credit. They have bank debt or not. You have 3 interactions, and it's very difficult to interpret. So my point is, let's focus on firms that don't have bank credit in the post period, and let's see what happens if they obtain new credit. So when they obtain new credit, the probability of exit diminishes. And with this we link with the facts. Okay? But what is more dangerous here is if we focus on safe firms and those with profits, the probability of exit in the market would have been much lower. Which means that not granting credit to good firms for which I don't have hard data can be bad for you. And then we just go back. Because this is the same idea. I mean, be careful focusing on hard data, because sometimes when there are no hard data, you are constraining firms that are good for the economy, but due to the absence of hard data, you are killing firms that are. Okay? And this is the last thing that I want to explain about hard data. Don't be crazy with hard data. Hard data is good, but hard data, as I have shown you in the 2 papers, have 2 limitations. First, it's easy to measure, but firms can lie. And then I'm using hard data that I don't do. And second, if I rely a lot on hard data, I'm killing some participants for which I don't have hard data. Apart from that, it's good. And then we go to the second part of the theory, soft information. Okay. What is soft information?
The information that's not typed.
This is the easy, but something else.
Signals.
Signals, yeah.
No se puede medir, not measurable.
Exactly. So it is. I mean, in some sense you can give a measure for that, but it's not like hard data. The measure that you obtain from soft information can be different from the measure that I obtain from soft information. They could be different. With hard data, no, because we go. Suppose that I don't know. Jesus said, okay, tell me the leverage ratio of this company. You take your way, I take my way, we go to the balance sheets, and we are going to get the same number. If he asks, what do you think about the probability of this firm of being able to, I don't know, to repeat the debt based on the characteristics of the manager? Probably you go to LinkedIn, and then you see there are many people now doing this. You see the connection between the manager, what did they study. Probably I go to the people, to the family that knows them, and they tell me, no, he's working very hard, you know. So it's different. In some sense, it's not that they are bad information. It's that it's more difficult to compare. In some sense, it's subjective. So it's not objective like the other one. So it depends on your view. It depends on my view. No? And the example is this. No, it's a loan officer's opinion. So the client can come to my office, and the same client going to a different office could have a different view from the loan officer. Does it mean that some of them is wrong? No, it means that it's not reduced to number. No, it's based on what? It's based on the personal interactions that you and I have with the client. If you go to LinkedIn, you don't have a personal interaction, but you can have good information. But the best way to build soft information is based on what? Based on relationship. Based on the number of times that the client come to my office to ask me about the loan and the connection that I have with them. Okay?
And if I make an indicator that based on soft information gives me a number or something that makes it hard information. And the soft information being driven
Yes.
hard information.
Yes. That's what technology is trying to do.
With the NLP and those things.
That's what technology is trying to do. I mean, nowadays, from the 90s, there are many companies that are trying to make soft information, to convert soft information into hard information. The case that I told you, the example of this friend, I mean, he's starting to lend to startups. He has no information on startups. What he did is to contact the American company, and they created a scoring based on soft information. It's not perfect because still you are missing a lot of things, and the relationship lending still matters. But it's true that there is a trend to convert soft information into hard information because we want to measure this. No? But this is the example that I'm saying. No? I mean, think about the family firm. It goes to the bank to ask for a loan. In the end, the more times the firm goes to the bank, the better is the information that the bank is going to have. But in some sense, it's subjective. It depends on the judgment in some sense, or the discretionary decision that the manager, that the bank officer is doing. Right? So I remember, for instance, a house. No? I give you an example of the buy of a house. When you buy the house, you go to the notary and then you sign everything. And then someone told me that this person sold the house to a couple. They were very risky, according to this person. When this person saw the interest rate that the bank was giving to this couple, the guy was saying, they know someone in the bank because otherwise it's impossible based on the information that they have. And this person was very surprised. It was in 2020 and it was like 0.75 percentage points fixed during imagine. I mean, this is of information, I don't know. Probably the guy in the office knows them and the impression that this person had on the same person was there. So what is the problem here? That many firms are opaque. This is the example that I have shown before, with zero-bounded firms. Opaque means that they are not transparent, they are startups, small firms, they don't have credit history, like the zero-bounded firms that I said before. So informationally they are very opaque. So it's very difficult, right, to give loans to them. The point is, if this happens, the loan the bank that grants the loan could take different decisions depending on whether the bank is small or the bank is large. What is the difference? In that a small firm goes to a large bank, very large bank, do you think that they are going to rely more on hard data or on soft data? On hard data. The small banks think about the cooperatives of credit, they know the client, they know the business, they rely more on what? On soft information. No?
They absorb the riskier clients, the small banks.
Sorry?
No, I think that from what I have seen, the small banks absorb the riskier clients. No?
Yes and no. I mean, I have a paper on that. What happens when there is a fire? And a fire affects a company. The large banks, there is a fire here, I know that the company has been affected. The small ones are absorbing risky clients affected by the fire. But what matters is that ex ante could be riskier, but what is important is what is happening ex post. You know the difference between the ex ante risk and the ex post risk. So the ex ante risk is the probability of default of the client. It could be riskier. But if the riskier ones are charged higher interest rates and exposed, they have a similar default rate, they are profitable. And this is what soft information allows you, right? So the problem is that it matters because, and this is related to your point, monitoring and flexibility is very important, right? I mean, hard information, you see the characteristics today, and you can follow the characteristics over time. But with soft information, you can monitor the client much more. So suppose that you give a loan to a client, this client has a small bar that is close to your bank, and you see that he's going every morning to the bar to drink wine or beer, right? And the bank, based on hard data, sees but let's see the financial statements last year. It's perfect. But the other guy has much better information. I mean, they can monitor, they can screen the client much better, right? That's why soft information is very important, right? And that's why, in some sense, when I know the client and the client is facing a problem, and this is very important, there are a lot of papers analyzing what happens with hard and soft information, for instance, during a crisis, or with hard and soft information when a firm is facing a problem. So suppose that I know that the person that is coming to me doesn't go to the bar, but this person is having a problem today that is not going to be persistent. I have more flexibility to continue lending to this firm and that this firm survives. And this is the example of the fire that I was saying. So there is a fire, I know that the firm has been affected. Look, they have a building here that has been destroyed. But I know that the guy is hardworking, if we continue with the business. So if I just rely on hard data, it means that I can cut lending. That's why it's important to have these small banks, these cooperatives of credit in the economy, because they continue lending to firms that could survive.
So, for small banks, do they have like some sort of limitation in terms of, I don't know how it works here again, but I remember in Peru, for instance, where I work in like a business, and only the larger banks have some department specifically for agribusiness because the way it works, and you don't understand the industry and you're reading financial statements, sometimes it just feels like you're going bankrupt when in reality they don't just get the feel of the business, and then they even go to the farms and analyze and see with their own eyes, so that gives a better assessment when they go to the credit committee. Well, the smaller banks, I don't know here, but in Peru they don't have that, so it's so hard, at least from my experience from that section in Peru, to get lending because they don't understand and they don't have the powerhouse to have a department specifically for that.
It's simple. So I tell you, for instance, the cooperatives of credit. No, I mean, many of them are specialized in the primary sector. So when you go, for instance, to Almeria, Cajamar, some regions of Spain, there are cases in which they have like 40% of the credit granted in that sector. It's the same. So the issue is nobody knows this sector as well. So if you see the NPLs, the proportion of clients that are not paying these cooperatives of credit versus the large banks in those areas, the proportion of clients that are not paying to the cooperatives of credit is much lower because they know the business quite well. It's what you are saying. So going back to the point, so they can lend to riskier clients ex ante because they know that ex post they are going to pay, and they are specialized in two ways. They are specialized in specific areas. So they have location specialization, and they have also sectoral specialization. So that's why, in some sense, to measure the local banks, you can focus in the province, or to measure the agro banks that you were saying, you can focus in the sector. But of course, they have much better information there, because there they don't use just hard data. They use soft information. They know the business. So we have to give you an example. I mean, some cooperatives. We have a bank lending survey that we conduct every quarter at the bank. And once per year, we have meetings with the credit risk officers. No? And when you have a meeting with a large bank, it's confidential, so I cannot give you names. When you have a meeting with the large bank, you see 15 people in the room talking. One speaks about mortgages, the other speaks about credit to this sector, the other, and they are so specialized. You have 15 people, blah, 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 blah. But in the end, I mean, in many cases, they tell you things that, when I read a report, I know this. But when you speak to the cooperatives of credit, that they lend just probably one or two sectors, you have two people, and they tell you everything about that. I mean, not just things that they can read, they tell you because they are specialized in that. So they are specialized, they have the hard information, and they have also the soft information. And it's what I was saying here. I mean, it offers you a competitive advantage. Sometimes the competitive advantage is not given just by the soft information, it's because you have complete market power, and then based on that, you define this competitive advantage in terms of this information. But this is very important for the small businesses, because the other 15 guys, if you ask about but what is happening in this sector, this is the person with this, nobody replies, because they have this generality. They are large structures, they are very hierarchical. So the banker in the office, before taking the decision, they have to send the decision to the province. So the headquarters in the province decides whether it goes to the headquarters at the national level, and then decide. And the value of such information vanishes as the information goes up. With the small banks, the cooperatives of credit specialized, the decision is taken in the office. So soft information matters much more. So they have more competitive advantage. And of course, I mean, this is subjective, so sometimes it's difficult to verify. I would say the example that, I mean, two different loan offices could have different views of the same client, the same loan. So this is not an advantage, but we need to consider this as a challenge also. It doesn't mean that it's bad. It means that, I mean, we know that this is a challenge, okay? And I'm going to stop here, because this is what I have said before, the transmission and the transition, what I have explained right now. I mean, there is a paper here, this paper by Liberty and Ian, and what they find here is that the value of soft information diminishes as the distance between where the firm is and where the decision is taken increases. Right? So the example of a large bank. So yeah, I give you the loan, but I need to see what happens with the headquarters in the province. Headquarters in the province say, yeah, I mean, we approve the loan, but let's see what happens. I mean, when the loans are large, if the loan is small, the decision can be taken in the office. But if the loan is large, the decision goes in different steps. And what this paper shows, the paper by Liberty and Nian, is that soft information matters is more and more important. But when you have very hierarchical structures, when it reaches the end of the structure, the value of soft information is very low. What continues mattering is the value of hard information, because it's more easy to transmit, right? It's easy to transmit, you see the paper, you see the numbers, so there is a challenge for soft information. And before the paper, it's difficult to storage and it's difficult to continue. So with the balance sheets, I can store the balance sheets in an Excel file or paper, and 2 years after I can tell you. So these are the balances during the last 10 years. With soft information, the challenge is that it's not easy to store, right? I mean, if you work in a bank and you leave the bank, the information goes with you. It's not that you can, okay, so let me write. No, it goes with you. It's your knowledge, what you learn. So that's why
Drinks in the bar.
exactly, and that's why, I mean, for these companies, the loan offices are very important, because if they go to another bank, they will lose everything based on soft information. That's why, and this is something that some banks talk. If you go, for instance, to regions in which you have cooperatives of credit, this is an idea. It's something that I didn't have time to check this, but this is a nice idea. If you go to a region in which you have cooperatives of credit, sometimes the national banks, the large banks, go for the clients that work with the local banks, because they know that the local banks know the clients. So there is competition in order to take the clients that I know that are working with this bank. Look, this guy has been working with Caja Rural de Navarra for 20 years. They are growing a lot. Right? This is good. They know him. They know him. Right? With the other ones, and that's why a nice way to do research is to see how these clients, how national banks, the large bank, compete in order to take the good clients of these guys, because they have much more information. So probably I don't need the soft information. I need to take the clients that are working with the guys that have soft information. And then here I will show you the other information about the Wi-Fi. Look at that. Compares what happens in terms of soft information when you compare large banks versus local banks or Western. Right? This is after, I think it's 4:30 or?
For 4:30 to 6:30.
Or 4. I don't remember. 4:30. 4:30. Okay.
4:30.
It's here. You
Yeah,
compare
it's
that.
Good.
Is it useful this?
Sí,
you make pixels, you let me know, okay? No, yo quiero que preguntéis. Y luego, después de la clase, we are going to see difference in differences based on the post period, but when we have a problem of staggered differences. That is when we are, in this period is 0, 1, the copy, blah, blah. But at fire, there are terms that are actually by a fire, they are doing one time, second time, third time, stages. Well, in the stages, all the program is single link. You see the file single link, and it's a new file. So you have a program that has been affected by a fire for day, but the year after, in summer is also affected. 2 years after is affected again.
Un niño que va a ir resto de eso.
Pero lo que quiero es que cuando tú aplicas el efecto, ¿se debe al fuego o se debe a que ha sido quemado 5 veces? Igual hay un pirómano que está quemando, ¿sabes?
Es un poco pobre. Estaría bien que tuviera.
Yo creo que lo consideran. Claro, al final la empresa depende de pero sí se considera toda la información, se considera información individual también. O sea, si el banco puede ver, cuando tú vas al banco, el banco puede ver la habilidad que tú tienes para pagar la deuda. Entonces, si tú vas a crear una compañía, pero tú como persona, por tu crédito al consumo, tarjeta de crédito, no estás pagando nada, no te lo dan. Pero ese punto es muy importante. Luego lo hablamos. Ese punto es que va desde household finance y corporate finance. Entonces, eso es una literatura muy chula que no nos da tiempo a ver, ¿verdad? Yo hice una foto para que veáis lo importante que es para los bancos, porque aquí los bancos aquí estamos mirando empresas, estoy centrado en este sentido, pero están súper conectados. Entonces, sobre lo que tú dices, es un buen punto para escribir en tus ideas. No hay mucho, ¿por qué? Porque es muy difícil machear la persona con la empresa. Pero ¿sabes por qué? Bueno, los datos personales hay mucha confidencialidad de información. Es muy difícil. O sea, yo no veo, yo para la empresa veo todo. O sea, el identificador, hasta la marca de ropa que llevas. Ahora, para los hogares, yo no veo nada, es aleatorio.
Data, privacy stuff.
Yeah, but not Europe, you have a lot of information on this. The issue that you don't have everything. But that would be, this is a topic that is amazing, it's very nice. Merging some sensitive with the household finance with the corporate finance.
Sí, porque anda sobrellevando la red de crédito, porque es un poco empresario.
Eran dos abajo.
Si no, es muy chulo.
Café, al que está
hacer eso, así tengo información.
Después sí, todo vaya arriba,
igual ahí puedes ver algo, pero sí puedes
vamos a romper esa mono.
España y Europa,
Vamos a hacerlo así.
y las encuestas
Corte comercial.
si es empresario,
Vamos a romper esa mono.
tienes un trozo, no es perfecto, es como tener información. Pero algo no se puede ver. Nosotros estamos viajando.
Produciendo música.
公主呀，祝我好好。 我也是。 可找美丽的高山，可找美丽的河，那条长路。嗯